is Thursday, May 11th here in New York City. This is Yahoo Finance Live. I'm Julie Hyman with Brad Smith, and here are three things you need to know this morning. No magic for Disney shares. The entertainment giant lost another 4 million Disney Plus subscribers in the first quarter. That's its second consecutive drop, but a little pixie dust, a narrowing in losses for the streaming business, and a strong performance at its theme parks. The latter helping the House of Mouse beat the street on the top and bottom lines. CEO Bob Iger in the midst of a turnaround, of course, and a plan to cut billions in costs. Second thing you need to know, another sign that inflation is starting to slow, if very gradually. April's producer price index rose 2.3% on an annual basis. That's below estimates and the slowest annual increase since January 2021. This as initial weekly jobless claims came in above expectations at 264,000, which is the highest level since October of 2021. All of this data points to some cooling of the economy and the labor market, though it's worth remembering the unemployment rate retreated to a multi-decade low last week. And the last thing you need to know, Jay Powell said the U.S. banking system is sound and resilient last week. Investors in the regional banks don't necessarily agree. PacWest shares plummeting again as the Los Angeles-based lender says deposit outflows resumed in the first week of May. They dropped 9.5% during the week ending May 5th. The bank also pledged around $5 billion of its assets as collateral in a bid to boost its ability to borrow from the Fed.
Let's talk a little Disney. Disney shares right now, they are trading lower by about 5.7% actually. We'll round that off too. After narrowly missing on profits, adjusted earnings per share coming in at 93 cents versus an estimate of 94 cents. The Magic Kingdom also taking a hit on Disney Plus subscribers. That number coming in at nearly 158 million. That's shy of the Street's estimate of 163 million. Now with us is Yahoo Finance's Alexandra Canal. Ali, you've been tracking the after-hour shares move here, even extended into this morning's activity as well, pre-market. What did the company have to say on the call? What really jumps out to you?
There were quite a few things that stood out to me. I think number one was Bob Iger's complete pivot when it comes to his stance on Hulu. Just a few short months ago, he was saying how he was, quote, concerned when it comes to undifferentiated content. He said, quote, everything is on the table in regards to Hulu's future. But on that call, he changed his tune. He said over the past 3 months, he's had time to really study this business. He calls general entertainment a very positive thing moving forward, and that the combination of both Disney Plus and Hulu is a great value proposition, not only to subscribers, but also to advertisers. He said, although he's not completely sure what's going to happen when that January 2024 deadline comes. Remember, Disney owns 2/3 of Hulu, Comcast owns the rest. That deadline is when Disney could potentially buy Comcast share of the streaming giant. He said, although he's not completely sure what's going to happen there, it was hinted that Disney will acquire Hulu once that time comes. So that was number one for me. And when we're talking about just subscriptions overall, those subscriber plans, he also talked about how more price hikes will be coming to Disney Plus, particularly surrounding that ad-supported tier. And that was also interesting to me because, as you mentioned, Brad, Disney did lose 4 million subscribers in the quarter because of those higher prices. Although Bob Iger did say he was, quote, pleasantly surprised by that churn. Therefore, he believes Disney Plus has the, quote, price elasticity to continue raising prices. And then finally, Bob Iger at length addressed that lengthy legal battle with Florida Governor Ron DeSantis. He basically proposed a question to Florida. Do you not want us to invest in the state? He said Disney is planning to invest $17 billion to create 13,000 jobs. He said it's a false narrative that Disney is doing this to avoid certain tax breaks. He said on the call, quote, we're the largest taxpayer in Central Florida, paying over $1.1 billion in state and local taxes last year alone. And we pay more taxes, specifically more real estate taxes, as a result of that special district. And he said that countersuit that Disney filed against Florida Governor Ron DeSantis and that current board, it was because of one reason only, and that's because he believes that DeSantis is retaliating against the company for their stance on the Parental Rights in Education Act, which critics have dubbed the Don't Say Gay bill. So this is just some of the issues at this company, but I do think that Bob Iger did address a lot of those investor questions, and we're going to continue to see how this plays out in the coming quarters.
Yeah.
Absolutely.
That was very thorough. I don't know what else to say.
I mean, it was. I guess the only thing I'd add is that the first round of the NBA playoffs here, that was the most watched ever by Disney across the networks.
Yeah.
5 million viewers. I'm only bringing that up because my Sixers are still in it. The second we're
Heck
out of
yeah,
it,
Brad.
I'm not watching it anymore.
Not just your Sixers, her Sixers
Yeah,
too.
my
No,
Sixers
yes,
too.
yes, indeed.
Philly people.
All right, let's talk about what investors are saying then in reaction to this. Disney, as we talked about, posting second quarter revenue in line with the street's projections. Earnings revealing significant growth at the company's theme parks. Revenue for parks, experiences, and products coming in at $7.8 billion above estimates. And as we look on how the stock is trading in pre-market, it is down by nearly 6% on a decline in Disney Plus subscribers. For more on this, we turn to Doug Kreutz, who's TD Cowen, Managing Director of TMT Media and Entertainment. Doug, I gotta admit, I'm surprised that the shares are down so much. And that's because, yes, subscribers fell, but the subscribers are more profitable. And it seems like maybe the company's on track or even ahead of profitability for streaming. Is that your view? And what do you think is going on here?
Yeah, I guess first I'd say it's not that they're more profitable, it's that they're less unprofitable. But I kind of agree. I'm surprised it's down this much. There wasn't that much in the report or the commentary by management that was surprising. We knew they were going to lose subs in the Hotstar regions, which are lower ARPU regions when they gave up the IPL rights. So that wasn't a major concern. I think there was some things that they talked about with the parks, that the sort of pricing rises that they've been able to get at the parks are slowing down. They've got tough comps against the Disney World 50th anniversary last year. They've got some cost pressure at the domestic parks. So, that's been a really big margin story that seems to be at least in abeyance for a few quarters. I think also it's worth remembering that Iger signed on to be there for 2 years, and we're already 6 months into his tenure. He has to make changes fast. And I think, listening to last night, they're making changes, but it's sort of, the effects of those changes are still seem like they're a ways away. So there's progress, but it might be a little slow for some people.
Which means if we're 6 months into that, we're about a year off from getting a true picture of who might succeed him as well here. I mean,
in theory,
that is the strategy that gets put forward by most companies, especially when you have a boomerang CEO as Disney does. So is there anyone from your perspective that has a good kind of sense of how to continue to operate the streaming business, how to continue to make sure that, as they talked about the parks business on the call last night, that can continue to be a key growth driver for the company, that can kind of fuse together all of these different drivers and at the same time be looked at as the street as a leader that can be trusted even to navigate a difficult economic backdrop?
Yeah, it's a good question. I mean, there were people like Kevin Mayer who I think the street would have been fine with, but for one reason or another, they got passed over. He got passed over and left the company. Doesn't mean he couldn't come back, but it would be a little strange, I guess. Because of that, a lot of the people, Tom Staggs was another, Jay Rasulo was another that had a lot of experience at Disney, are gone. Have been gone for a while. Obviously, Bob Chapek, for various reasons, didn't work out. So that, do they have to go outside the company? That's tough, just because Disney has such a powerful culture, a dominating culture. To bring someone in from the outside, you never exactly know how good of a fit it's going to be. So, there's no sort of clear heir apparent yet. And they certainly haven't really elevated anybody in the last 6 months to make them look like the heir apparent. Again, it's a little early for that, but they've got to be thinking about it at least.
When we talk about the streaming business, Doug, and it seems like, as you wrote in your note, that we're going to get another price increase for the ad-free tier here. As a Disney Plus user and someone with kids in the household, I feel like it's a place we're going to more rarely these days because we've tapped out a lot of the content that we want to see. Are you confident in the slate of new stuff that's coming to that platform, or do they need this sort of Hulu, ESPN, Disney Plus offering to even just keep the momentum going?
Yeah, I think it's, to be totally blunt about their strategy, we're going to make the product worse and charge you more for it. And to be fair, that's the strategy of all the other streaming services right now too. We're going to make less content. We're going to pull content off the service that was there, and we're going to raise price. They've been giving a lot of content away for too low of a price. That's why everyone's losing money. But if you're the consumer, it still doesn't feel particularly good. And I think, they didn't grow subs in their core markets last quarter. They basically said they're not going to do it again this quarter. They were more optimistic about the back end of the year when they say they have more content. Then you sort of get down to, okay, how are their content sort of machines doing? You look at Lucasfilm, you look at Marvel, two really important ones. I think their output on the service has been a little mixed. There's been some very good shows. There's been some other shows that haven't worked. I would argue the stress of having to produce for Disney Plus has potentially affected their theatrical output as well. It's been 3.5 years since the last Star Wars movie, and it's probably going to be another 3 years until we get the next one. Marvel had a rare miss with Ant-Man earlier this year. Guardians is doing well, but not as well as the last Guardians movie, even though arguably it's a better movie. So there may be some, I don't want to necessarily say customer fatigue for those franchises.
You can say customer
but maybe
fatigue.
A little wariness about. Sorry?
I said you can say customer fatigue. Maybe.
Yeah, look, I don't believe in fatigue around genres or franchises as long as the quality of the product remains really high. People love great product, but I think the quality has been a little more hit or miss lately. So it's a tough needle to thread. I think bringing Hulu onto the platform, certainly it's a nice quality of life benefit for people who do subscribe to both products, not having to jump from one app to the other. Does it herald a point at which Hulu and Disney Plus totally get rolled in together domestically? Maybe, but then, what does that mean for all the money you spent acquiring Hulu in the first place, and the money you're going to have to continue to spend to buy in the last third from Comcast? So they've still got a tricky transition here to get from where they are now to getting to a point where the streaming services are really generating meaningful profit.
Doug, it wasn't until I unfortunately did the math on this before the show, but I haven't been to a Disney park in 20 years. Now, I hear the experience is vastly different than it was 2 decades ago, and it pains me to say that. But at the same time, that's great for Disney. It sounds like there's a lot of fanfare around the new experiences. This is also a key growth driver, as we mentioned earlier, for the business. What does Disney have to do to get parks right on a continued basis with all of the international expansion that they discussed on the call, and while they're still navigating, of course, some of the economic uncertainty in those different regions, where in some regions it's, okay, we finally turned the page from the COVID era and stricter policies, and in others it's, okay, well, consumers are also going to be monitoring how much they're spending into that experience even while they're there.
Yeah, I think, most of the discussion around Iger surrounds sort of the content side of the business. I think he probably doesn't get enough credit for what he has done on the park side since he first took over, almost 20 years ago. Basically, their game plan has been, we're going to invest a lot of money in the parks. We're going to expand capacity. We're going to make the experience better for guests. Well, recently, they even moved into sort of it's a bit of a discriminatory pricing model where if you're willing to spend even more, you can get an even better experience. And as someone who has gone to the parks about once every decade in my life, I have a little bit of a mixed feeling about that, but it's certainly working well for them. They're going to continue to grow capacity across their whole parks footprint. They've got another cruise line coming out. They're expanding, the Shanghai park. There are other international parks. They're going to continue to invest in the domestic parks. The Marvel's Avenger campus has been a big hit. So, it's just continuing to invest, continue to make it a great experience, a premium experience, and then, making sure the guest experience is really positive.
Of course, Bob Iger was asked about AI because everybody is being asked about AI. We just want to listen to what he had to say on the call when he was asked about it.
I'm looking forward to a time where maybe AI does earnings calls for me, and you wouldn't know the difference, perhaps. Maybe they'd be better. I don't know.
So he joked about it at first, right? But then he did talk about the potential as well as the risks for it, right? But he talked about it in sort of vague terms. So it didn't seem like it's something that the company is concretely working deeply on right now. Do they need to be? Is there a big potential there for them? It seems like everybody is talking about it right now.
Yeah, I think, one of Bob's strengths is that he has pretty good relationships with the creative community. And if you mention the word AI to creatives, they freak out because they're like, you're coming after my job. I think Bob's smart enough to understand that AI isn't going to replace creatives. They're making human products for human beings. That said, I think there's areas where AI can certainly help the creative process. And so I think, he understands it's a tool that they're going to want to engage with, but he's going to want to be very careful about how much he sort of touts that, because he doesn't want his key people who are creating all this great content to feel like they're going to be devalued.
Yeah, no, that's a great point. I mean, well, we'll see if, as the analyst had asked on the call too, or at least mentioned in commentary, if analysts start to just have their own AI bot chime into the call and ask the questions after they've been able to kind of ingest the earnings report as well. Doug, thanks so much for taking the time here on the day. TD Cowen's Doug Kreutz, we appreciate it.
Thank you.
Definitely. Is the economy starting to cool? April's producer price index, that rose 2.3% on an annual basis. That's below estimates and the slowest annual increase since January of 2021. This as initial weekly jobless claims came in above expectations at 264,000. That's the highest level since October of 2021 here. And so just taking a look at some of the context that was added within this report on the PPI front, particularly 80% of the rise in the index for the final demand, that's attributable to about a 0.3% increase in prices for final demand services and final demand goods. They advanced by about 0.2% there. And then they go into some additional context, less food, energy, trade services rising 0.2% during the month.
Yeah, and all of this is good for the Fed, to put it simply. As we talked about earlier, this is gradual. This is not like inflation is day one, right? But this is directionally the right place that the Fed wants it to go. That is, we are starting to see the job market slack start to come out a little bit, right? And we're not seeing jobs as plentiful. We are seeing, even though, yes, the unemployment rate is very low, there are some signs creeping in of a little bit more weakness there. There are some signs creeping in that inflation is starting to come down to some extent. I'm just looking at, as I like to, the Fed Watch tool on the CME,
yes.
right? What is the current probability about what's going to happen for the next Fed meeting? And there's currently nothing being priced in for an increase at the next meeting. There's a very small probability being priced in of a cut of about 3.1%. And then if you go out to December, as I like to do as well, there are much more probability being priced in of a cut at that point in time, which would imply the economy is going to slow a lot more. But it's always interesting to see what people think after these kinds of reports.
Absolutely. And I know we've spent a lot of time tracking even eggs as well, and egg production here particularly. I told our team to cue the egg graphic, but all in, important to note that the index for chicken eggs, that dropped 37.9% here. You also saw prices for jet fuel and light motor trucks also decline. However, some of the areas where you did see advances, 8.4% advance in prices for gasoline. That was a major factor in the April increase in the index for the final demand goods. And then prices for fresh, dry vegetables, carbon steel scrap, plastic resins, materials, aircraft and aircraft equipment, that also moved higher as well within this report.
Yeah, let's also talk about, of course, one of the areas that is greatly affected by the Federal Reserve. That's regional banks. PacWest shares tumbling on news that deposit outflows resumed at the regional bank. It's down another 23% today. This follows days after PacWest assured investors it was not experiencing the, quote, out of the ordinary deposit flows that rocked other regional banks. The majority of declines seem to coincide with the upsurge in concern again about PacWest on May 4th and May 5th after a report that PacWest was weighing a sale that spooked investors. So definitely what was happening sort of in the public markets coinciding with what was happening to bank deposits. On the other hand, we've got Western Alliance also coming out this morning saying its deposits went up by $1.8 billion since the end of the first quarter. As of May 9th, total deposits at that bank were nearly $49.4 billion, up nearly $600 million from May 2nd. We're going to take a wider look at the regional bank moves later on in the show, Brad.
The will they, won't they debate over the Fed's move at its June meeting will keep us entertained until, well, June. But in the meantime, the narrative around the head of the central bank isn't exactly great. Today's morning brief doesn't hold back, saying Jay Powell's approval rating will keep tanking if he does his job right. Our colleague, Ethan Wolf-Mann, cites a new Gallup poll which shows just 36% of adults having either a fair amount or a great deal of confidence in him. Ethan joins us now. Ethan, walk us through the morning brief, your take, and what really is at stake here for Powell and the Fed with regard to the general public sentiment?
Hey, Brad. Yeah, thanks for having me. I think what's really interesting here is that, Powell's numbers are down. And what's interesting to me, at least when I saw this, I was like, okay, wow, they're going to get a lot worse if he does his job. These are the worst approval numbers of, I think since the Gallup said of all time. They haven't been tracking this that long, but, certainly in the past, since the Greenspan era. And what's interesting is we've already seen 10 months of slowing inflation. And we're talking about a recession, but we're not in one yet. And that's this really interesting thing is that, the pain is actually fairly limited for the worst Fed approval rate of all time. This doesn't really seem fair to me. I don't think anybody really needs to be carrying Jay Powell's water. He's doing just fine, and he's a big boy. But it's interesting to think about this because, why really? Is it the prices, which are coming down? I mean, they're not as worse as job losses. And if we've seen, if we think about the March projections, things are going to get worse. That unemployment rate is very low. So, obviously, the only person whose approval really matters at the end of the day is the person who says, here, you are the Fed chair, and that's Biden, of course. And so I whether this is, that important, I think is moot here, but it's interesting to sort of see the public perception of this role. And, again, another reminder of it's probably a good thing that this isn't an elected position because you would see something very different.
Yeah, I mean, to your point, Ethan, there is a certain subsector of the financial punditry that always hates what the Fed is doing, not just when they think that we are headed towards a recession, but also when they were cutting rates, that they were setting us up for disaster. I guess what's unusual here is more the public opinion. I mean, I wonder when I see these polls, if you ask most Americans what's the name of the Federal Reserve Chair, they might not know that. They just know they don't feel great right now.
Yeah, that's something we saw, in this data. They talked about Yellen, they talked about Biden, and some of the other leaders in the Senate and in the House, and there's a lot of don't know. And I think a lot of times people are like, who is that? They probably still think it's Ben or Janet or somebody like that. But I think the other thing here is this is a thankless position, and I mean, if we remember back in the Volcker era. Man, they were nailing 2x4s. The construction industry was nailing on the Fed's facade, and so I think there's a long history of hating on the Fed, and that's something that it's sort of our scapegoat. I think all the politicians can sort of try. I mean, Trump was doing it. Biden has not done that. I don't think he will do that. But it's sort of like, okay, you appoint this guy, and you kind of can blame the bad things on him because it doesn't really matter at the end of the day, unless that comes to a head. But I think it's interesting to think about how this might evolve, because if we're starting at a low before the recession, where are we going to go here?
Yeah, it's a good point. Ethan, good write-up today in the Morning Brief. Make sure everybody subscribes to the Morning Brief if you don't already. Thanks so much, Senior Editor Ethan Wolfman. Appreciate it. Well, staying with the Fed, HSBC's economists expect another rate hike at the June meeting, followed by a lengthy pause well into next summer. And a fresh note, the cross-asset team says equities have generally performed pretty well post the final rise. Let's bring in Max Kettner, HSBC Chief Multi-Asset Strategist. So Max, good to see you. So that suggests that whether they raise in June or the last one was the last one, if history is any guide, that suggests stocks could do pretty well here?
Yeah, exactly. And good morning to you as well. So I think it doesn't really matter, I think, for our outlook, whether this was now really the last one or whether we'll see another 25 basis point rate hike in June. I don't think that's going to move the needle an awful lot too much. I think what's going to be much more important, what you said in the previous section about that probability of the rate cuts in the second half, right, until December. So I think that's going to be much more important. If we really go into the second half and if we realize, we've got about 3 rate cuts by the Federal Reserve priced into futures markets right now, if that doesn't happen and markets and investors really start to realize in the second half of the year, look, that's not going to happen. Things are a bit too strong and the hopes for those rate cuts are a bit overdone. I think then we could get a bit of trouble for equities and for risk assets in general. But that's quite a few months away, right? We're talking maybe in 3, 4, perhaps possibly only in 5 months. Until then, I think we can ride this Goldilocks wave, right? You just mentioned the note that we wrote, where generally what we found is that post the last Fed rate hike, we're actually seeing pretty decent gains across all the asset classes, whether that's in equities or whether that's in treasuries or whether that's in corporate credit.
So looking at the year-to-date performance, though, on the S&P 500, I mean, it still seems like we're hovering around what has been the tops of this year. So does that mean we're set for more volatility in the midterm in this kind of larger try and pick when you can get in, pick when you can get out type of trade here, at least in this near-term scenario that you're describing?
Yeah, I would fully subscribe to that view, and I would actually also extend it and would say that's probably something that we've got to get used to over the next, not only in the near term, the next couple of weeks or months, but really perhaps over the next year or year and a half. Because bear in mind, what we have right now is sort of a slow grind lower in growth, right? In US growth, things are a little bit better than people really expected 6 months ago. So it's not really this big swoosh lower in terms of global growth momentum, but it's not particularly great either, right? On the other hand, we see inflation heading in the right direction, but a lot of that is now driven by base effects, and that's going to at least not reverse, but not be going to be as supportive in the second half for US headline inflation in particular. And that's going to mean that basically US headline inflation can reaccelerate a little bit towards the end of the year as well. So that's going to be bad as well. So I think equity markets are going to stay torn between these push and pull factors, right? Of bearish factors. Oh, you mentioned jobless claims, much worse than expected. You get a few other data points, however. Look at the earnings season in Europe, in the US, much better than expected. And on the inflation side as well. For now, we're heading in the right direction. Later this year, we might be reaccelerating a little bit. So we're going to be really, really pulled and pushed in those ranges. And I think it's really, really important to get the timing right, because I do believe that perhaps in 6 or 12 months' time, we could find ourselves really talking about the same things, right? The same sort of index levels, really. So a buy and hold strategy will not work. We're going to have to be a lot more tactical and a lot more active in the next coming months.
That sounds like it's a lot more challenging, Max. One of the other areas that I was noticing in your note that tended to perform well in past cycles was investment grade credit. That was sort of the other one that kind of stood out to me. And is that an area also that you guys are looking at right now? Do you think it will be as volatile as the equity market?
No, I mean, in general, you've seen investment grade credit really, really perform quite well after the last Fed rate hike. However, in reality, that is mostly a function of the drop in government bond yields, right? So what you typically see is that government bond yields, both on the short end of the yield curve and the long end of the yield curve, they're starting to go down after the last rate hike, and that really helps investment grade credit. That's mostly a function of that, not really of the credit markets per se. So what we're really looking at right now, given these pull and push factors, and given that we're still thinking that it's pretty range bound for now, particularly in yields, would much rather go actually up the risk curve, right? So be overweight in high yield credit, in emerging market debt, in emerging market local currency debt, right? So really picking up a bit more sort of the higher carry and higher beta carry asset classes.
Max, it's always great to get some time with you and get your perspective. Max Kettner, HSBC Chief Multi-Asset Strategist. Thank you. Well, we've got the opening bell on Wall Street coming up in just a moment. And as we look at the futures here this morning and as they digest the jobless claims data, the PPI data as well, we have seen the futures, not necessarily move as much as they did to something like CPI, but we are seeing Nasdaq futures point a little bit higher, I believe, and S&P and Dow futures here pointing a little bit lower, Brad.
Yeah, and in that futures move that we've been tracking, we were higher in the futures at one point, and now, as we've seen kind of take place over the course of the morning with some of that economic data that's come out, we've shifted into negative territory here for the S&P and the Dow, as you mentioned. It's going to be interesting to watch financials out of the gate this morning, especially considering some of that regional bank activity, which we can get a check on at the start of today's open as well. And then, of course, keeping an eye on the House of Mouse, Disney, as we begin today's trading session here. We did see some decline declines here pre-market. We'll see exactly how that trading transpires as we begin the session in just about 20 seconds.
Yeah, it feels like the push and pull that Max was talking about is especially acute in times when we don't have earnings, right? And we sort of go into this drifty period where it's economic data, it's Fed outlook, that tends to become more important.
And we're waiting for retail, too.
Yes, we are.
Those big retail names.
That should be important as well. So there we have the opening bell. Sovos Brands, which makes those solo stoves that are sitting in many backyards that many people bought during the pandemic, for example. I'm not talking about myself or anything. So yes, indeed, that's what we're seeing. So if we look at the markets opening up here this morning, we see that mixed picture, and we see the Dow and the S&P trading a little bit lower. The Nasdaq has yet to open up, but it looked like futures were indicating a little bit of a higher open here this morning when it came to the Nasdaq. So it looked like we were setting up for a mixed picture, and indeed we are. It's up about 0.1%. Brad, what's going on over there at the Touch?
Yeah, let's take a quick look at how we're charting kind of coming into today's trading activity. Over the past 3 days, down by about 0.7%, 0.75% for the Dow. Right now out of the gate, though, it's lower by a little more than 0.5%. Nasdaq Composite, you're seeing that flat just barely to the upside, so holding on to some of those gains there by the hair of its chinny chin chin, I might add. Past 3 days, though, up by about 0.5%. S&P 500, you're seeing that in negative territory past 3 days, down 0.25%. About the same on a percentage basis here out of the gate this morning. We're going to take a quick look at sectors here on the S&P 500. Then we'll get to some of those regional banks here. Sectors for the S&P 500, you've really just got communication services and consumer discretionary in positive territory right now. Communication services leading the pack as of this point, and then you got some staples that just barely got into positive territory. XLE, though, bringing up the rear. Right now, it's down by about 1.5%. Looking for XLF, as that's going to allow me my segue in a quick moment. That's down by about 0.8% for the financial sector. Let's take a look at some of those regional banks, especially considering the news out earlier on today. PacWest Bank saying deposits declined by about 9.5% during the week ending May 5th. Much of that decline seen during the 4th and 5th of May here. And so there you're taking a look at some of those regional banks out of the gate this morning. Really not too many bright spots to be found. I mean, you take away some of the banks that had already failed, and so now you're thinking about where that move in PacWest is netting them. And yeah, PacWest down 26% as we start off today's trading session. Western Alliance down about 4% right now, Julie.
Yeah, interesting to see that coming back to the fore just when we think we are sort of done with or getting to the close of this whole saga, something else kind of springs up. It is weird to see Western Alliance down when it said its deposits actually climbed, which seems to indicate that it's more sentiment driven once again than perhaps fundamentally driven. But we will keep tracking it, of course, and what's going on in those regional banks. Coming up, investors turning down the volume on Sonos. We'll have details on why the stock is down 20% next. Shares of Robinhood are getting a boost today after its earnings showed a jump in interest income due to Fed rate hikes, but still saw monthly active users slip. The online brokerage also announcing a new 24-hour trading platform 5 days a week. Yahoo Finance's Diane King Hall joins us now with the details. I think the shares were originally down, weren't they not?
Yeah,
and now
but
it looks like they've turned higher.
They turned higher, yeah, indeed. Robinhood, definitely one of the stocks we're focusing in on today. The company, it did report a net loss of $511 million or 57 cents a share on an adjusted basis. Now, trading activity is down from a year ago, but revenue was better than expected at $441 million. That beat the $422 million expected. Robinhood is also working to reverse that trend of activity being down, as you mentioned, with a new 24-hour trading service, not 24/7. The new feature is dubbed 24-hour market and will operate 24/5, meaning it will allow for 24-hour trading 5 days a week. The service will allow for trading in 43 securities, including some popular names like Apple, Amazon, and Tesla. The feature will start to roll out next week, and all of its customers are expected to be able to access it by June. So you can see what Robinhood is doing here. I mean, of course, they were one of the beneficiaries of that meme stock frenzy, and they're trying to kind of regain that volume that they lost with another new service.
Yeah, I mean, they were also at the center of it because they had to halt trading in certain names until they had the necessary liquidity as well. Interesting to see, even in the uncertainty in the banking sector, too, that got a mention on the call. They're continuing to see strong net deposits and improving customer satisfaction, they said, as well within this.
And the deposit also having to do with another feature they rolled out earlier this year, IRA, people being able to invest in that service. So that is another way they've pulled in customers by just offering new services and new features. I mean, and Robinhood has certainly been doing a tightrope act in terms of the challenges that they've had to deal with.
Yeah, one more thing on here, too. I always do kind of control F for crypto mentions within Robinhood. They talked about their new wallet that they've launched, the 130 countries that had been kind of adopted in and users have seen some type of connection point with. But it's interesting that even in this period of time where there's been more of a push for cold storage, where Robinhood might have a place within the crypto wallet transactions and actually functionality, at least in this interim period of time.
And one more thing to mention that has nothing to do with the earnings, and that's the SEC is looking into
I saw that.
trade reporting related to its securities lending and fractional share trading. It seems like it might be linked to some of the fines that banks paid in recent years over unauthorized chats between employees, perhaps, but that's something we're going to continue to watch.
Yeah, so they're definitely under the microscope there, but it's not affecting the stock today.
It is not. Diane, thank you so
All
much.
right, you got
Appreciate
it.
it. We're also watching Sonos shares this morning. They are plunging after the company saw revenue sink by 24% in the second quarter. They cut the full year earnings guidance as well as consumer demand is softening for its speakers. And this is one of those sort of pandemic paybacks that maybe was a little delayed, perhaps. Everybody, beefing up their auditory experiences at home during the pandemic and now seeing a waning in demand.
Yeah, interesting. You never want to hear an earnings call start out with this was a quarter of this quarter was a tale of two cities. Of course, if you're Charles Dickens or at least the heirs of such, you would love to hear that because it gives a nod to the tale of two cities, best of times, worst of times, though, is what Sonos is essentially saying here. And here's what the best of times was. They executed successful launch, talking about the Era 100 and Era 300, those products, getting those into market, next generation of the best-selling Sonos One here. However, here's where you get into the worst of times, perhaps. Even as they made all of this progress, they said on the earnings call, the near-term macroeconomic pressures we have flagged throughout fiscal 2023, they intensified in Q2 and diminished our second half and full year expectations. So they knew this would be a challenging year and they had to downwardly revise their second half expectations and investors reacting accordingly.
Yeah, one interesting comment for me from Brent Thill over at Jefferies, who said that the macro challenges are definitely an issue here, but it's an issue not just for Sonos, for its competitors as well. And he says Sonos does not appear to be giving up market share in this environment, which I guess is a little bit of a silver lining.
I mean, electronics have been challenged, right? And look no further than directly at a pure play electronics speaker player like a Sonos right now to see some of that challenge really playing out in this particular period of time.
Yeah.
Also, we're tracking shares of Carl Icahn's Icahn Enterprises. They're tanking after the company revealed in an SEC filing it's under investigation from federal prosecutors. The U.S. Attorney's Office for Southern District of New York contacted Icahn the day after Hindenburg Research released a short seller report accusing Icahn Enterprises of a Ponzi-like structure here. This particularly interesting, and the disclosure of it coming forward from Icahn Enterprises as well.
Yeah, this story is so fascinating to me because Carl Icahn is no stranger to battles, right?
Yeah.
But usually the battles are not over his own company. Usually, in the past, he and Bill Ackman had a very public spat over Herbalife, for example. He has had tussles with other investors over his investment positions, but never, to my knowledge, over his sort of holding company itself. So that's what's different. Icahn, really a titan in the asset management investment industry. He's been around for a long time as a successful and well-known aggressive investor here. But it's just a fascinating story to me. Hindenburg, by the way, has a new report this morning on Icahn and is saying they are now short the bonds of Icahn Enterprises, even as this investigation is going on.
Yeah, some of the kind of big, bold letters that you would see if you took a look at this latest kind of response that Hindenburg posted. Perhaps the most pressing question raised in their report concerned Carl Icahn's pledging of over 181 million IEP units, that's 60% of his personal holdings, for margin losses. They went on to say, despite promising to respond at length to the issues raised in the report, Icahn Enterprises offered no new details, and that coming from Hindenburg this morning.
Yeah, so those shares are continuing to see some pressure. You see the decline that happened after the initial report and what has since happened, down 41% over the past month.
Absolutely. We're also tracking shares of Bags, Heels, and Bags today. Tapestry is jumping after the company raised its profit outlook. Despite a slowdown of luxury purchases in the U.S., the Coach handbag maker saw demand rebound in China and saw overall net sales climb 5%. We talk about some of the rebound and companies in retail, and perhaps this could be or offer at least a little bit of a precursor to the rest of some of the retail earnings that are still set to come, how they're navigating a consumer in China that is ready or where they had cited pent-up demand, and if that is actually carrying through right now as it is for Tapestry.
Yeah, it does indeed. So we've got Coach, we've got Kate Spade, and we've got Stuart Weitzman. They're the three main. The China sales were up about 20% in constant currency. So that is really to what the company is attributing the beat this quarter. And it says revenue is going to be about $6.7 billion for its annual forecast. It's the second time it's raised its forecast for the full year over the past 3 months. So just ratcheting up expectations. And as we look to the read-through for retail, I think obviously the read-through would be to the higher end of retail, to China exposed retail as well. So we're going to be watching those types of companies very closely.
I mean, I almost even bought some Tiffany Air Force Ones during the first quarter.
Yeah, well, that's more of an LVMH brand.
Yeah, LVMH, yeah, but the high end, I would say. Right, is what it.
Nothing but high end for Bradley.
Nah, I mean, look, man, I still shop anywhere. I was at Target yesterday. Anyway, guys, coming up, the AI race. Regulation is playing catch up, but companies continue to make fast moves in the space. None more so than Microsoft. We'll speak with a business it's just invested in. That's coming up next.
won't even know that it's AI taking your order. But you'll be talking to the voice of Wendy's, be it a consistent voice. It may upsell you along the way today.
Todd, is it your voice? Is it your voice?
It's not my voice.
Okay, just wanted to check.
God help us.
That was Yahoo Finance's Brian Sozzi speaking with Wendy CEO Todd Penegor on its results and a push into AI at the fast food chains, all-important drive-thrus. The full conversation ahead. But there are new potential rules in the EU that you would have to know it's an AI voice, because staying with AI, the European Union is moving closer to some form of regulation. A draft bill says any company creating so-called foundational models should be required to produce risk assessments and let people know when they're interacting with the technology. The plans still need approval from member states, and it comes as China pushes ahead with its own regulation and concerns mount that the U.S. is behind the curve. Last year, the White House published its so-called blueprint for an AI Bill of Rights, but stateside regulation on this space is still very much a work in progress.
That's right, and regulation is playing catch up, but companies, they continue to make fast moves, none more so than Microsoft, which has invested billions in OpenAI. That's the startup behind ChatGPT. As everyone jumps on the bandwagon, the tech giant isn't slowing its efforts. It announced a deal with Builder.ai, a startup that helps companies make applications without any coding experience. Joining us now is Sachin Duggal, who is the Builder.ai CEO and founder. Sachin, great to have you here with us on Yahoo Finance. First, take us into this larger AI push, what you're seeing, the demand, and how ultimately you're going to be able to monetize what you're putting together for some other companies to be able to access.
So firstly, thank you so much for having me in the morning. When we think about what's happening in the world at large, and this is, before ChatGPT and what we're seeing with OpenAI, we've seen a rapid push towards digital transformation. Whether it's a small business, it's entrepreneurs that are trying to build ideas and they need to be digitally native. And companies like ours are using AI to accelerate the productivity for them to get to that endpoint, right? So they don't have to become software experts. They can simply talk about their idea. We can recommend the right set of features depending on which region in the world they're in, what kind of features they're building. Broadly speaking, I think where you're starting to see this play out into everyday life is productivity applications. You think about things like Copilot. They're going to help us do a lot more with a lot less. And that means that if we think about the aggregate amount of demand for work that even comes into a startup like Builder, and the aggregate amount of supply we have, whether it's our expert network or it's our own teams doing internal work, this actually helps us level the playing field and brings back some balance for a lot of folks.
Sachin, how is this going to be integrated into Teams? And what else do you expect to do through this Microsoft partnership?
So the Microsoft partnership for us is quite broad stroke. It starts with a core alignment on mission and vision. And I know that many people say that, but for us, it's about together, how do we build the next 100 million digital dreams? Is that a small business? Is that an enterprise transforming? Is that an entrepreneur building new ideas? And so the partnership is multifaceted. From where do these applications live? How do they get a premium service on Azure? Another example is, imagine you're in an enterprise. You have hundreds of thousands of users that are talking about day-to-day problems that they have in their business department. Maybe you have a warehousing department. And now Natasha could be invited to Teams. Natasha is our conversational AI, could be invited to Teams. And at the end of the call could say, hey, listen, I think you need a warehouse scanner. Your other department in Japan has already built this. And you can have this in a week because it's using these Lego-like reusable features and putting them together. On the other hand, we've heard about this new role called prompt engineering. But actually, Natasha talks to ChatGPT and acts as the prompt engineer. So when she's having a conversation with a customer or she's prompting one of our sales experts as they're speaking to a customer, and she doesn't quite understand the question, because she's not a large language model, she can go to ChatGPT with the full context of the conversation, the features, and then be able to decide that the answer ChatGPT is given, is it suitable for the customer or not, and then pass that answer forward.
How does Natasha get smarter? Yes.
So Natasha is based on this concept of a knowledge graph. If you think about the human mind, it's a very robust knowledge graph. And I don't mean to obviously belittle the human mind because I think it's profound. But a knowledge graph is ultimately nodes and then relationships. Think about it as a relationships between neurons in our mind. And what Natasha does over time is, as she starts to understand the relationship between customers, between features, for example, you can't log out before you log in. If you want to do payments, you need a credit card gateway. If you are a retailer, there's a high probability you need a shopping app. And then she's also able to understand what you mean. So, if you started to say, I'm a small business, I sell shoes, she might show you a shopping app with shoes in it. And then you could say, I do, high-end women's shoes, and she switches the trainers to high-end women's shoes in the pictures. And so this is the learned behavior, and the graph is really how we're able to build the software brain.
Sachin, am I always going to know I'm interacting with Natasha? And I ask that because of what we were just talking about with the new EU regulations that say it's got to be clear when you're interacting with an AI. Do you think those regulations are reasonable?
I think they're absolutely required. And so a lot of what you'll see that we do is you can effectively talk to Natasha today in one of two ways, in the future one of three. So today you can chat to her. Very clearly you're talking to her. We over-index that. We even give her age. And then when it's a human that takes over, she'll tell you, hey, listen, I'm handing over to a colleague. There's another way you talk to Natasha, which is she powers a lot of the sales, and we call them productologists, but think of them as customer success. She's starting to power a lot of that conversation. So she's asking them the question, and then they're asking the customer. And for us, this is powerful because it means we can remove some of the variability you get in a sales process or a customer success process, yet leave the human in the middle in that process. And then as we go forward, where Natasha establishes a voice, it's going to be key for us to leave digital signatures in place so that, if a recording is ever checked, it's clearly verified that this was an AI generated voice rather than, one that's internal from the organization.
And Sachin, finally, I don't suppose you'll tell us how much Microsoft bought Builder AI, but I am curious if this opens the door to a bigger partnership between you two, if you're courting other big tech companies, and whether you guys are going to go public at some point in the near or distant future.
I think that's a loaded question, but
yes, it is.
But I would say, I can't tell you the amount, but Microsoft's investment in Builder, money is a small part of it. And this is why I start with a sort of joint vision around the customer. We're working with Microsoft to go to market. We're working with Microsoft to build new product and to make either side's products richer, which I think is the key here. It's not just consumption, but it's a two-way partnership. We're really collaborating and growing. And for us, the partnership is significant, not because of an equity ownership, but because we now have, effectively a big brother that can help us as we figure out our own journey between now and when we go public, and guide us through that journey, having obviously done this many, many years ago. And I'd say the second piece to this is with Microsoft, as we also start embracing more enterprise customers, we get a level of credibility because we're working together with someone that's really tested the competency and the tires.
What does that mean in terms of profitability for the company? Are you already profitable? At what point do you believe you'll be profitable? And do you think that it's profitability before IPO or IPO before profitability?
I come from the school of thought that you should be profitable before you go public, because I think the public investor has a different risk profile to a private institutional investor, whether it's RVCs or Microsoft in this case. We have always been very focused around unit economics, very focused around watching cash, very focused around burn. And so for us, profitability has been something that we've been in and out of almost on a monthly basis for the last year. Last year we were profitable, but we're also spending more in R&D. So I think it's a balance. But we're not the kind of business that's going to run away with the bank spending with no onsight of what the future revenues might look like.
Really interesting developments, partnerships that you've been able to net, and congratulations on that front. Look forward to more news to come on that. And if you ever want to decide to let us know how much Microsoft put into it, we're all ears. Sachin, great to have you here with us today. Coming back here on Yahoo Finance Live with us, Sachin Duggal, who is the Builder.ai founder and CEO. Sachin, appreciate it.
Thank you so much.
Thanks. Guys, coming up, Wendy's delivered a pretty solid quarter, but the bigger news was actually all on the AI front. What will the next voice of Wendy actually sound like? Find out in our interview with the CEO. It's next.
Wendy's reported a beat on the top and bottom line in the latest quarter, but the real news there might be the company adding AI technology to its drive-through windows. Yahoo Finance executive editor Brian Sozzi talked to the Wendy's CEO Todd Penegor to discuss the quarter.
When you look at the health of the consumer, we have seen items per transaction come down a little bit, but not materially. And within our menu, we haven't seen a lot of mix shifting go around. In the first quarter, we sold more large hamburgers than we have in the last 6+ years, at a time when, we have a trade up from 4 for $4 into a $5 biggie bag into a $6 biggie bag. So we feel like we got a good menu construct to bring folks in for one more visit, drive one more dollar that works for the consumer, but also works for our operators too along the way. And when you look at our relative value to what's out there in the grocery chains, for a fresh prepared high quality meal, we sit in a really good spot to continue to compete well.
Interesting you mentioned large burgers, Todd, because I've been talking to a lot of the CEOs in the sit-down restaurant industry, and they have seen good amount of traffic from people that want to feel fuller, I guess get more bang for their buck. So what you're saying is consumers are coming more into your restaurants and buying larger burgers because they see more value in that?
Yeah, well, you look at the course of 2022, we did see a lot of trade down from the sit-down restaurants, from the mid-scale casual restaurants. We're not seeing as much trade down today, but those customers that came in and tried us last year when they traded down are sticking with us. And you're seeing it across all income cohorts. We continue to hold our share in the under 75,000 income cohort, continue to do the same on the over 75,000. And we're seeing a lot of growth with that over 75,000 income cohort. And they're showing up at Wendy's more often, which is a good thing for our business, too.
That cohort, annual income over $75,000, where do you think they're trading down to? Obviously, they're going to Wendy's, but is there another chain that you feel that you're gaining market share from?
Well, no, when you look at it in total, I mean, QSR Burger is doing that as a subcategory of all QSR is doing quite well. Obviously, our biggest competitor had another nice quarter. But when you look at other QSR Burger competitors, we're widening the share gap against them. So we continue to do quite well in a very competitive category. And when you look at, where folks are trading around in different categories, you're just seeing that there's a lot of winners and a lot of losers. It's not really tied to one specific category within QSR, but QSR continues to be the place to be. Speed, convenience, affordability are core to what the consumer's looking for today. We'll continue to differentiate on the great quality messaging that we've always had.
A couple of moments ago, Todd, you mentioned a competitor. Let's call them Ronald Arches. Since we last spoke, they have updated their buns. They're now melting onions on a burger. To them, this is mind-blowing. Do you have to respond by changing how you make your burgers?
No, we're super proud of, fresh, never frozen across our whole lineup on our hamburger business, been who we are from day one. You think about what we've done on the grills and our upgrades that we're making in our restaurants right now today to move to what we call a DSG 2.0, which creates a better sear, more juicier hamburger and cuts the cook time in half so everything can be made to order. Us doing everything from a full customization standpoint to really differentiate from other competitors. Our fresh message is strong. We saw that in the first quarter. We talked about Squares the Beef as a big campaign and knock back to our old, Where's the Beef campaign. And it resonated with consumers. That's why we sold a lot of large hamburgers during the first quarter, and we'll continue to do that. I think our operational procedures make the best hamburgers in the business, and we just got to continue to execute that day in and day out in the restaurant.
Well, speaking of operational procedures, you are now pushing into the world of AI. Do you see yourself as an AI stock? Because now you're going to be out there putting AI technology into drive-thrus, and walk us through this.
Yeah, not an AI stock. I see us as an innovation company, right? As we lean into innovation, how do we play the game different? How do we digitize a restaurant? We talked a lot about our global next-gen design, really having a digital forward set to it all. How do you get into the restaurant, out of the restaurant with a mobile grab-and-go order? How do you take a kiosk order? How do you take a mobile order for a grab-and-go to pull up to the front of the restaurant, or a delivery driver getting in and out faster? That's where we started. Now we're really thinking about how do we take some of the friction and make the experience even more seamless at our restaurants. How do we set our employees up to be in a position to succeed and make their lives a little bit easier in the restaurant? Get them positioned to work the grill station. Get them positioned to make hot and juicy hamburgers fast and accurate every time. Get them out the door and handed fast with a smile. That's what we're trying to do, and taking the slowest point of the order journey out and really trying to make sure that nothing gets lost in translation. Everybody has a better experience, and ultimately driving more speed and throughput in the restaurant, so we can deliver on the promise that you can get in and out of a Wendy's fast with great tasting food every single time.
How intense is this going to look, that drive-through experience? So let's use me as an example, Todd. I come to Wendy's at 12 o'clock in my two-door sports car. Maybe I was out, maybe I wasn't, whatever it was. Is that drive-through experience going to know what I want to eat as soon as I drive up?
Not today. So what you're going to see today is basically just taking out the traditional order taker. You won't even know that it's AI taking your order, but you'll be talking to the voice of Wendy's, be it a consistent voice. It may upsell you along the way today.
Todd, is it your voice? Is it your voice?
It's not my voice.
Okay, just want to check.
God help us, Brian. But no, we'll have a consistent voice out there. But what we'll have on the digital menu boards is a confirmation. So you know that your order was taken right. You'll get to see it real time. And then ultimately we'll get you through the restaurant very quick. So when you think about different languages, different dialects, we'll be able to quickly make sure that nothing gets lost in translation, both from a customer or an employee perspective. But over time, as you start to think about how do you take a digital menu board? How do you make it a smarter digital menu board? How do you connect, the voice AI, the digital menu board, ultimately to our loyalty program? how do we make sure that we got a more personalized, customized menu to support what Brian wants when he comes to the restaurant? How do we trade you up when you come into that restaurant in the future? Those are all opportunities, a little further off, obviously, but you got to start laying the pipework and the platforms today to really bring all of that to life.
And that was our own Brian Sazi with Wendy's there. Guys, coming up, regional banks, they are back in the spotlight again today as PacWest shares, they're plunging. What this means for the financial sector. Next. Welcome back, everyone. The FDIC is out with a proposal to replenish funds used to bail out Silicon Valley Bank and Signature Bank in March. Yahoo Finance's Jennifer Schonberger joins us now with the details. Hey, Jennifer.
Good morning, Brad. That's right. The FDIC holding a board meeting right now where they are proposing recovering funds used to bail out both Signature and Silicon Valley banks back in March by charging fees to banks with assets of $5 billion or more, essentially sparing community banks here. Breaking down the details, the largest banks, those with total assets of over $50 billion, would pay more than 95% of the so-called special assessment to recover losses to the Deposit Insurance Fund, according to the FDIC. The FDIC estimates that a total of 113 banks would be subject to this special assessment. No banks with total assets under $5 billion would be subject to this. To put that in perspective, the overwhelming majority of banks, some 96% of banks or 4,500 banks, will not pay for this. Community banks lobbied the FDIC very hard to be excluded from having to pay for SVB and Signature's bailouts, arguing that they did not engage in the risky practices that led to those banks' demises. Now, the FDIC is required by law to bill the banks that benefited the most from its assistance, in this case, the large banks with the largest amount of uninsured deposits. Now, a little math for you this morning. The way the fee is calculated would take the total uninsured deposits as of December 31st, 2022, subtract 5 billion from that and multiply it by 12.5 basis points. The FDIC has extended payment terms over 8 quarters to try to mitigate the effects of capital loss on banks. Total loss is estimated at this point at about $16 billion, though that could change depending on the number of assets still in receivership that need to be sold off as the FDIC goes through that process. Now, the FDIC board is going to vote on this proposal this morning. That would start the clock for a 60-day comment period, aiming for a final rule later this year, and for this to go into effect in the first quarter of next year, with banks liable for their first payment by the end of the second quarter next year. Guys?
Our Jennifer Schomburger, thanks so much for keeping us up to date on what's going on with the FDIC here. Thank you. And let's say on the regional banks and the implications of all of this, right? Because the FDIC is making this announcement as PacWest shares are down again this morning, down 15%, and they keep being halted for volatility. That's after the bank reported deposits fell over 9% last week. Joining us now for more in the financial sector and really what the economic implications are is Matthew Luzetti, Deutsche Bank Securities Chief U.S. Economist. Matt, it's good to see you. And I know we're going to talk more broadly about the Fed and the economy, but I have to ask you about the banks here and what the implications of what seems to be continuing issues are going to be. I mean, we know that it's going to crimp lending, right? I guess the challenge is quantifying that.
Yeah, I think it's hugely important for thinking about the Federal Reserve, whether or not they raise rates again this year. It's hugely important for thinking about an economic downturn and potential recession risks. We saw early in the week, we got the Fed Senior Loan Officer Survey that showed that banks continued to tighten lending standards. Maybe not as much as feared on businesses, but certainly on commercial real estate. We saw demand for loans was very weak across residential mortgages, commercial real estate, and business loans. We saw bank lending conditions for consumers tighten pretty aggressively. The Fed thinks that this is going to take away from the need to raise rates further, that it's going to impact demand, therefore help to bring down inflation and impact the labor market as we look ahead. Calibrating that at the moment, I think, is really, really difficult, but I would agree with them that that's going to be a big impact on the economy.
I mean, this comes after we're continuing to see this hit on deposits for some of the regional banks, as Julie was mentioning. So with that in mind, we've heard the messaging over the course of the earnings season that the banking system is still fine. It's still strong. But at this point in time, investors trying to get ahead of something else. Is there something else, another shoe to drop here?
Yeah, I think what we see in the aggregate data we get from the Federal Reserve, of usage of their lending facilities, it's been stable and actually declining over the past several weeks. I think that's been a positive development. We'll get another data point on that this afternoon. When you look at the Fed's H8 data, it looks at deposits and bank balance sheets. Again, that's been pretty stable over the past several weeks. So, when Chair Powell says that the system is stable and broadly improved since early March, I would agree with that. Certainly there are fundamental stories going on, which is that market rates are well above a lot of deposit rates. And so it makes sense that depositors are looking for higher investments elsewhere.
We talked earlier in the show about how low the approval rating of the Federal Reserve Chair has fallen right now, and that it's perhaps not surprising because people are not feeling great about the economy. The Fed is purposefully slowing the economy in order to bring inflation down. But I do wonder, the discussion, not so long ago was all about the Fed sort of making a mistake and needing to pivot when it didn't act quickly enough to address inflation. What's the biggest risk of a mistake now on the part of the Fed?
Yeah, I think to your point, we always talk about the Fed taking away the punch bowl before the party gets started. So that's usually not a high approval rating for the person that has to do that. The risk today, I think we don't expect the Fed to raise rates again. We think that their last rate hike was in May. But the risks at the moment are we've seen inflation data which remains pretty sturdy at elevated levels. We've seen a labor market with a jobs report last week that was really, really robust. And there is a risk here that the Fed is stepping back, thinking that credit conditions are going to tighten and that they don't have to do any more, but that we're forced to replay this kind of start-stop hiking cycle that we had during the 1970s. Ultimately, that proved to be a far more painful experience. I think that's the new risk that the markets have to deal with.
So that's really interesting that you say that, because there are certainly some critics out there who are saying that the risks are sort of balanced the other way, that the Fed risks being too aggressive. It sounds like you are taking the opposite side of this, that inflation could actually prove to be even more persistent than the Fed is planning for.
Yeah, I think what we've seen over the past year was a Fed that was willing to over-tighten because inflation risks were the key objective from their perspective. I think the credit conditions, what we're seeing in the banking sector, kind of just injects a new uncertainty, injects a new risk for the Fed. We know that they're stepping back from rate hikes at the moment. If we did not see what was happening in the banking sector, it is likely they would have raised rates by 50 basis points at the March FOMC meeting. And so they have already not done as much as you would have expected if not for what was happening in the banking sector. So really, it's maybe not the key risk, but it's a new risk that markets have to deal with. This idea that inflation is still too high, the labor market is still resilient for the time being, and it's possible that after taking a break, the Fed has to re-hike rates later this year.
And so what does that in turn do in the labor market as well? Is there a byproduct that comes as a result of that? Because the employment situation, to your point, has remained strong to this juncture.
Yeah, I want to bring in this morning's data as well. We did see jobless claims, particularly initial jobless claims, spiked higher. And up until the latest week, it just looked like they were moving back towards levels that we saw in 2019. This is the first time where we've seen them very clearly rise above the 2019 levels. Claims, I think, are the best kind of contemporaneous indicator for recessions. I'm not saying that they're suggesting recession today, but if they were to continue to rise, it is a real concern, I think, that the labor market begins to weaken. Outside of that, the rest of the data, certainly last Friday's jobs report was robust kind of across the board. So mixed signals from the labor market at the moment.
While we have you here, I got to ask about debt ceiling, unfortunately. If it happens, GDP hit. If it lasts a month, GDP hit. If it lasts 2 months, GDP. Have you guys been gaming out all of those scenarios?
Yeah, look, I think it's hard to quantify exactly the impact. I think we know probably two things at least. I think getting to a resolution is likely going to require that markets react, that they force the two sides together, that you have some down trade in the S&P 500, some widening in credit spreads. That tightens financial conditions and ultimately impacts the economy. I think the second thing that we're likely to see is that we do get some spending cuts legislated, probably not nearly as large as what is in the Republicans' plan, but meaningful spending cuts are likely necessary as part of a deal. Both of those things are negative for growth at a time where we are already kind of worried about recession risks. We're talking about banks tightening credit standards. It's this event risk plus the underlying backdrop why we've stuck with our view that Q4 is the start of the recession.
Well, the markets so far definitely are not forcing their hand. So we might, June 1st, we'll see how close we get to the deadline before that happens. Thanks, Matt. Great to see you. Matthew Luzetti is Deutsche Bank Securities Chief U.S. Economist. Great to get some time with you always. Well, one trending ticker that we are watching, it's a frequent one, Peloton shares are tanking this morning. The company doing another recall. We're talking about 2.2 million bikes being recalled because of an issue with the bike seats. Peloton received 35 reports of the seat breaking and detaching from the bike during use, including 13 reports of injuries. The company is telling customers to contact Peloton for a free repair. But obviously, this is just the latest issue for this company. It's experienced recalls with its treadmills. And now, it's hard to imagine you're on the bike and the seat falls off?
Yeah, 2.2 million units here, as you were mentioning, and this was issued by the Consumer Product Safety Commission here, and they went on and talked about how the bike seat, the post seat, can basically break during use. You can have a fall, injury hazard to the user there, and this is another recall in a string of recalls that had taken place previously for the Tread Plus model. You had seen that, where it was possible for pets or even small children to be able to unfortunately get stuck underneath of that and have serious injury. And so all of that considered, on the connected device front, where Peloton has had to take steps to either get some of those connected devices into an experience like a hotel or into other wholesale partners to get that into homes then, and had to even deal with the secondary market. This is just another hit on a bike that is largely probably in the secondary market right now, so can diminish not just future sales for Peloton of this if they are kind of refurbing and then putting back out into the market, but then additionally just a broader hit in a string of kind of hazardous situations that they've had to navigate.
Reputational risk. Yeah. One thing I will say that is quite different now with this recall versus the prior management and the Tread recall. Remember we had that whole back and forth where Peloton was sort of resisting the calls for a recall, was resisting the allegations that it was hurting people, right? And that a recall was necessary. This one, it seems to be, these recalls are all technically voluntary, right? It seems like the company is cooperating from what we can tell with this one. So a different tone, certainly, and more proactive. I think you could argue.
Cooperating.
We need to get more information, but it seems like that's the case.
Yeah, I mean, I hadn't seen anything up on their investor relations site,
True.
on their own homepage. So
they're letting the CPSC handle this one, I guess. All right, coming up, are you kind to your neighbors? Maybe, maybe not. A new AI experience may help you to be kinder, at least online. We'll be right back. Let's do a quick check. The market is now sponsored by Flex Shares. We've got all three major averages now that have turned into the red, with the Dow leading the way down. That is a switch. The Dow off by about 1.2% right now. The S&P down 0.6%, and the Nasdaq off 0.5% in today's session. I suspect, although I'm not certain, that part of the reason why we've seen the Dow take a bigger hit today is, as we saw yesterday, which is that oil is down. Oil stocks are down, and so we see some of the oil majors in the Dow that are helping to weigh on it. Crude oil right now I'm seeing down about 2%, and it is just around $71 a barrel. Well, shares of social networking service Nextdoor are up on an earnings beat today. Revenue coming in at nearly $50 million. That's a 2% decline from the last year, but it's still above the street estimates. And we saw the shares are now slipping, actually. Total weekly active users coming in at 42.4 million. That's up 16% on an annual basis. And this earnings report comes on the heels of a big announcement. The company is integrating generative AI, specifically ChatGPT, into its platform. Joining us now, Nextdoor CEO Sarah Friar, Yahoo Finance's Brian Sozzi with us as well. Sarah, it's great to see you. I want to start with the AI, actually. Let's just get straight to that, because I think it's really interesting, right? We have this whole discussion about how we will be using AI in the future. You guys are already doing it, and it's basically helping people, write posts on the platform, right?
Yeah, I mean, that's exactly right. First of all, Nextdoor, remember, is the local network. We have the local knowledge graph. So if you're going to do something in the AI space, you have to have the data to be able to make it useful to your customers. Second thing that we have is people are naturally generating content. So in a world of generative AI, It just fits. So what did we launch? We launched an AI assistant. So as you're writing your post in your neighborhood, let's say you're trying to make a bit of extra money, right? Times are tough right now. Or maybe you want to get your neighbors together to do something like build a community garden. As you write that post, our assistant offers a better way, potentially, to write it. It's up to you. The user has control. But we know, based on our data, what's going to be most engaging on the platform. And that's what the assistant is helping you with.
Sarah, Brian here. Good to see you as always. You've been around tech for some time. As you see this wave of AI, what are some of the risks to your business from it?
Yeah, Brian, I think, are you suggesting I've been in tech for a long time?
No, I'm not. You just said that. I'll just teach you up.
So first off, I think on the positives, you can take it as you can extend it even. So that same assistant is helping people be kinder on the platform as well. So one of the risks we always see in user-generated content is people want to have tough conversations, but sometimes they don't know how to have them constructively. So we've already had something that slows you down called Kindness Reminder. It asks you to edit your post, and now we're actually offering you a suggestion. Overall, as we launched it with a clear set of principles that really define how we think about privacy, transparency, safety, and areas like inclusivity. And I think it's really important that companies lead with that so that their customers can see, here's how that's being used, here's how I have control, and making sure that we're always experimenting, testing, and learning quickly.
So to make sure we understand you, effectively what you have programmed ChatGPT to do, or generative AI to do in this case, is like sort of a niceness filter, if you will, or a diplomacy filter if people are writing posts.
Yeah, it's just a better way to create a constructive conversation. One of the things I always say is, look, I grew up in Northern Ireland. I grew up in the Troubles. We just had the 25th anniversary of our peace agreement. People would have never gotten around a table to create peace if they hadn't been able to figure out a way to talk about the toughest things, but in a constructive way. And so we're just using technology to give you that extra prompt, that extra bit. Again, you don't have to use it, but we know what works on our platform, and we know how to make that platform work for you as a neighbor.
Part of that is also addressing the reality that there are a lot of mean neighbors out there, Sarah. So what does the platform do to kind of look across the conversations that are taking place and making sure that there is safety that's being promoted in these groups, in the chat rooms that may be transpiring, and in order to make sure that there is still a civic duty perhaps that the platform is adhering to as well, and making sure that there is a wholesome and also productive and constructive conversation taking place?
Yeah, so think about just how Nextdoor is constructed. First, we make sure you're a real person living in that real neighborhood. That authenticity usually makes people act their better selves. There's no kind of dark areas to go to. Nextdoor is a very open platform with a set of community guidelines. That's why you're seeing users flock to the platform, growing 16% year over year. On top of that, we have baked in a lot of social science, things like our kindness reminder. We have a constructive conversations moment where we slow you down if we can tell the conversations are getting more heated. And overall, we just put our transparency report out. Only 0.2% of all of the content on the platform is deemed harmful. It's moderated by 210,000 community moderators. These are volunteers in their community that want to make their neighborhoods better. And if content is violative, it comes down in 5.1 hours. So the net effect is actually neighborhoods are becoming very vibrant. They're a great place to get things done. If you need a side hustle, you want to find some dollars in your closet or in your garage, you want to get your community rallying around a great cause. And in my community right now, everyone's talking about what are we going to do for Memorial Weekend, what's on for kids, and it's just a great way to see what's happening locally.
Sarah, how are you allocating resources to all things AI? Because in tech right now, there's still that focus on cost management, but then by the same token, you have everyone trying to stand up this next leg of potential growth.
Yeah, you just can't get left behind when these huge technology shifts happen. So you're right. If you look at Nextdoor, we've held our operating expenses about flat for the last 3 quarters. But if you look at what's been going on effectively under the hood, we have been hiring up a big AI team. We started that investment back really in 2021 going into 2022, it's not just about generative AI, right? AI has been underpinning platforms like Nextdoor for many, many years now. We use that data to do things like a better notification, right? The right notification to the right neighbor at the right time brings them back to the platform. It's a way we personalize the news feed. So the things that work for me may not work for you, Brian, but we try to make sure your feed is personalized for you. So we do have to keep investing here. We have to stay really out in front. And we wanted to move fast on the generative AI front because we wanted to let anyone, any neighbor in the world that's on Nextdoor gets to see what this technology is like, gets to benefit from it. And we think that's an important part of really democratizing a whole new wave of technology.
It's really fun to talk about all this stuff. It's not as fun to talk about what's going on with your stock price, I have to say, Sarah. I don't know, maybe I need to put this through the nicest filter, but I mean, you guys came public at what, $10, right? $238 is where I'm seeing the stock trade around right now. How does this get you guys to profitability? When is that happening, and what's going to be the catalyst to get this company to recover stock-wise?
Yeah, so in the end, we control what we can control. We face the ad market. Last year was a tougher time. So number one, getting to profitability means revenue growth. So if you look at what we did last year, we leaned into the areas that we could see were working. So recession resilient verticals like government and healthcare, we built sales teams around that. We've really leaned into the mid-market. It's done incredibly well for us. And we've been building those relationships with advertising agencies. As we get bigger, we're now over 80 million neighbors on the platform. We start to really perform for advertisers. So we know that if you look back in 2022, we entered Q1 growing almost 50% year over year because we're doing really well in verticals like financial services, real estate, home services, things that are super endemic to local and to neighborhoods. Those advertisers haven't left us. They're just not spending as much. They will come back. And when they come back, we're building on top of other new opportunities that now we've built out. So that's how we make it to profitability. It's by keeping our operating expenses tight and under control, but really growing on the top line. And what we signed up to with investors, and we feel really good about having had this very strong Q1, is that we'll be back to revenue growth in 2023, and you will see margin improvement.
Just lastly, while we have you here, Sarah, when we think about the number of either new construction starts on residential properties or even commercial real estate starts as well, how does the Nextdoor team get into those conversations early, or at least make sure that the tenants are aware of the platform, and then that you've got even more usership that continues to transpire through that platform in the future to ultimately get to some of those profitability metrics that you've set forth?
Yeah, I mean, you're touching on a demographic that works incredibly well on Nextdoor, new movers. So when you move into a new apartment block, maybe it's into a new neighborhood, it's always the time. In fact, there's a stat, I think people spend something like 70% of all the money they'll spend on their home, they spend in the first year, because it's when we can all still see the things that maybe we don't like as much. So it's a great time to find a local contractor, a great time to find a local plumber. It's also a great time if you're setting up which supermarket am I going to go visit, or do I need a car now in this neighborhood, or maybe I don't need a car. It's a great time to make friends. It's a great time to build out that community. And so it tends to be when Nextdoor really sings. So we, of course, are always looking to see where are new starts happening, making sure that we're leaning into those neighborhoods. One thing we've seen in the last year is both brand awareness has really increased, but also brand sentiment. And I think it ties back to where we started this conversation. We put a lot of investment into building vitality on the platform. We recognize that great neighborhoods make people want to come join online, but then importantly, take that online connection out into the real world and to make their neighborhoods better and stronger.
Yeah, I believe that. I'm a member on Nextdoor as well, Sarah. I mean, I even had to check my profile to see if anybody's gotten back to my golf messages. They have not. Nextdoor CEO Sarah Fryer and Brian Sazzi.
Sazzi AI just hit you with the message.
Yeah, there you go. Thanks so much, Sarah.
Thank you all. Take care now.
Coming up, everyone, Google is entering its AI era. Dan Halley breaks down the latest announcements next. Shares of Alphabet popped on the company's sweep of AI news. Google's annual developer conference saw the unveiling of new AI integration across Google products. Yahoo Finance's Dan Howley has boots on the ground in California. Dan, what caught your eye yesterday?
Yeah, Brad, there were a number of big announcements here at Google I/O, and you can see I'm still standing around at part of Google's Googleplex. I don't know what's happening behind me or what's going on with that roof, but it's a cool campus. And so some of the big announcements that we saw were part of Google Gmail Help Me Write. This is a generative AI aspect of Gmail that's going to be laid out across workspaces, but for Gmail specifically, it will allow you to basically have a prompt and then help write an email. And one of the examples that CEO Sundar Pichai had pointed to was if you had missed your flight and you're trying to get a return on that ticket. So you would go and write out, I missed my flight, I need this, I want to get my money back, or, I'm not going to take this flight, I want my money back. And you would press the Help Me Write button, and it would then create this long flowing text message. You can then elaborate on that. You can hit elaborate and it'll make it even more elaborate, as you can imagine. So basically putting together an entire new email for you that you otherwise might not have wanted to write or might not have been able to phrase the right way. There was also the announcement that they're adding generative AI to search. Now, this is still very early. It's in the testing phase, so they're only allowing trusted users to get access to it at this point, if that. And what it'll do is essentially kind of ape Microsoft Bing, where you will get a search result. Say they did an example of a bike that's good for a commute with hills. And so it'll give you tips on what you need when commuting over hills with a bike. Then it'll give you a list of potential bikes that you might want to buy. Then you can go into a more conversational type of search with that generative AI bot and get more answers to more questions that you may have. All along the way, by the way, Google emphasizing that ads will still be a part of the process. That's basically just giving a little nudge to advertisers saying, hey, our business is still our business. And then finally, we also saw that they're bringing Bard to all users. And so they're going to be rolling that out across the board. It's still going to be in the testing phase, so it's not a final product yet, but you will be able to have conversations with that AI agent. And so you'll be able to ask it some conversational questions, get conversational responses, and so on and so forth. So really, those are the three pillars that we saw kind of rolling out at I/O, in addition to that cool folding phone they had.
Very interesting stuff here. I look forward to when you're back in the office and I can look over your shoulder and get some tips on all of this stuff. Appreciate it. Dan Howley out there on the Google campus. Thank you. Well, coming up, Traeger cooked up an earnings beat for the quarter, but slowing grill sales are giving investors pause. We're going to speak with the company's CEO next. Traeger grilled up an earnings beat in the first quarter as higher prices offset slower sales, but revenue for the company's grills took a hit, falling 40% in the quarter year over year. Joining us now, Jeremy Andrus, Traeger CEO. Jeremy, thanks for being here. What my compadre to my left here likes to call the grill replenishment cycle, not necessarily at its peak right now, so to speak. I wonder what normalized growth looks like for you guys. Obviously, you got a big lift during the pandemic. Things are slowing down pretty precipitously here. What's the level? What's the base level here for you all?
Yeah, it's a good question. I would start by saying that Americans have always grilled, and food is becoming more important to Americans. So there's a long-term trend around food as an experience and around backyard cooking. We've gone through an interesting moment in time where the pandemic was a real tailwind to the category. And then when the pandemic ended, Americans said, at number one, we're done buying high-ticket durables, and we want to travel. And so there was a very clear and very sudden shift in consumer behavior. But I think it's always important to step back and think about what is the thesis behind Traeger, and why is it intact, and why will we win long term? And I'd say, first of all, we've been a share taker for 10 of the 10 years that I've been here. And so, if you were to rewind back to 2013, Traeger and wood pellet grills did not register from a market share perspective. We're now about just north of 12% of the dollar share of the outdoor cooking market. We're clearly going through a tough moment, but Traeger wins because we have by far the best product experience, and we measure that through a Net Promoter Score. We really believe in bringing innovation and experience to our consumers, and we have this vibrant community that absolutely loves Traeger and loves to self-identify with the brand, the community, with creating great food and sharing it. So no doubt, I mean, we're in a tough moment in time. But I think if you look at the quarter that we had, we are showing real signs of stability. The platform is alive and well, and we're sort of balancing some of these post-pandemic headwinds with an eye towards making the investments so that long-term we will continue to win and be a share taker.
I'm going to clip you saying that Americans always grill and send that to the heads of my apartment building who close the grills for certain months of the year because it is a travesty. I'm trying to get outside, throw some stuff on the grill. Net, here as we think about the wholesale side of this equation too, what are you hearing from your wholesale partners that are trying to move through inventory still?
Yeah, that's a good question. And this, I would say, has probably been the most painful part of our business. And notably, as a company trying to have visibility into sales. So the first quarter of last year, retailers took in a lot of inventory, not just of Traeger, but of everything coming out of the pandemic where demand was high and where there was just an insatiable amount of demand and not enough supply. And so retailers really brought in a lot of inventory. As sell-through declined, retailers said, no more inventory. We need to slow that down. And so this destocking phenomenon created a really difficult year. Combination in 2022, combination of sales being down and destocking. Retailers were replenishing, let's say one grill for every three that they sold. And that makes it really hard to gain visibility because we're beholden to this retail partner in the middle. And we've got some phenomenal partners, but we had to work with them to help bring inventory levels down. The good news is that inventories for Traeger in channel are getting really healthy. We made tremendous progress in the first quarter of this year. Channel level inventories are looking good. We believe they will be very, very clean and healthy by the end of the second quarter. And I would also say our own inventories have improved a lot. We experienced a 14% sequential decline in inventories between the fourth quarter and the first quarter. And so as we're whittling down this inventory, as we're starting to see some macro trends in our favor around cost inputs that will drive gross margin in the back half of this year, the name of the game is like manage through a challenging moment, but stay focused on this long-term objective of a very vibrant brand and community and innovation in a product experience that consumers really care about and are willing to invest in.
Well, on that last point, Jeremy, are you seeing any consumers trade down in grills to less expensive grills? And what kind of discounting is happening on Traeger products right now?
Do you know what? We were more promotional last year than we have typically been, with the objective of really bringing our inventory levels down and freeing up working capital. We have been less promotional this year. In fact, we're a believer that great brands don't go on sale very often, and we are back to a more traditional cadence. It was actually very insightful to see as we came into January and we were full price. We were full price throughout the first quarter. So the results that we delivered are at full price. And I really think that speaks to the quality of the brand. I would say the grilling environment is more promotional now than it has historically been, but it's not for Traeger. We're driving full price business, and we feel really good about our consumers' willingness to pay. And there's really no trend towards trading down to lower price points. Traeger's a premium brand. We are accessible, but we're premium. And so we really speak to a consumer who's willing to invest in the experience. And even in a tough economy, we feel good about the mix of business that we're doing from a product perspective.
All right, Jeremy, I got to try out one of those new flat grills as well that I just saw in the video side by side. So we got to talk about that at a later date. Jeremy Andrus, who is the Traeger CEO, thanks so much for taking the time here on the day.
Thanks.
And Sovos Brands showed up strong in Q1, beating earnings estimates and updating its guidance for the year ahead. Shares of Sovos Brands outperformed the S&P 500 so far in 2023, even as inflationary pressures weigh on shoppers. Joining us now, we've got Todd Lachman, who is the Sovos Brands founder and CEO. Todd, great to have you here with us this morning. First and foremost, walk us through the quarter, the catalysts that you're seeing in this relationship among consumers and some of their preferences.
Great. Good morning. Great to be on the show this morning. So, first and foremost, couldn't be more thrilled with the results for the first quarter. Growth 27%, volume led, highly differentiated versus our peers. Volume up 16%, price up 11%. So we're seeing nice price flow through. So pricing and productivity helped obviously more than offset inflation, with EBITDA up 30% year on year. And those results are Q1 results plus the momentum really coming out of last year through this year. We took our guidance up meaningfully for the year, and now at midpoint, projecting around 16%, 15% top line growth, 16% bottom line growth. And really the driver of the momentum of the business is our cornerstone brand, Rao's. So the Rao's brand grew 38% in the quarter. LTM, that brand now is over $600 million in net sales. So the Rao's brand, 618 LTM, up 40% year on year, driven first and foremost by sauce. And we saw sauce household penetration in the quarter increase, the largest quarterly increase we've ever experienced on the brand in the last 3 years. And again, this brand is developed, though still the penetration level of 13% is well below several of our peers, which is above 30%. So we see still a lot of runway on the Rao's brand, and our non-sauce businesses, which now comprises 20% of the Rao's franchise. And that would be soup, that would be dry pasta, that would be frozen entrees. We just launched pizza. Happy to talk about that in a second. That combined non-sauce business grew 46% in the quarter. So really pleased about the momentum, and that led to taking up guidance as well for the full year.
Hey, Todd, when we're looking, whether it's Rao's or Noosa or Michelangelo's and the new products here, none of them, as you're talking about, are that penetrated right now, to your point. How much of the sales gain that we saw in the quarter was increased distribution versus sales of existing? In other words, in the like-for-like stores, the places where you guys have been, how are sales doing there?
Phenomenally well. So that's a great question. What we're seeing is honestly like the consumption level that we grew was, really 38% net sales, high 20s from a consumption basis. So we're seeing very strong velocity consumption growth and like for like. Our penetration is 13%, but that's really households. From a distribution standpoint, we've been approaching 90% ACV distribution on this brand really as of 2 years ago. So from a distribution standpoint, the brand is well penetrated in stores. The opportunity is to be well penetrated in households. So the like for like sort of growth has been very, very strong. It's actually comparable with our consumption growth, though we did gain even more distribution during the quarter, up 22% year on year. And our awareness, as I talked about on the last quarterly call, went up. The Rao's brand went from 48% to 58%. But still, there's 5 or 6 sauce brands that have awareness above 90%. And that's what we really like to highlight. Even though our growth is as robust as it is now, we're projecting significant growth in the future because our unit share is only 7%, because of our price point. Our penetration 13% versus 30, awareness 58% versus 90%, and our average number of items is 14 versus 20, greater than 20 for several of our peers.
Todd, you'll have to forgive me because living in New York has kind of taken me out of the frozen pizza or ready-to-make pizza market for a little bit. Yeah. We got some good options up here. But what kind of margins do you look for on announcing or launching or entering into the pizza market, as you were just alluding to a moment ago?
Sure. So the frozen pizza market is a large market. It's roughly $7 billion in size. And we target at least a 2 share in all the categories that we enter. For example, we're a 2 share, a little bit over a 2 share in soup now, approaching a 2 share in dry pasta. So the margin structure that we target for any of these new categories is to be comparable with the Sovos brand average. So although we have super premium products with high quality ingredients, so our sauce, for example, you've got whole tomatoes, slow simmered with olive oil, garlic, real ingredients versus paste, water, sugar, canola oil for mainstream players. We look for the same thing in pizza. It's a wood-fired crust, Rao's sauce, very high quality premium ingredients on the pizza. But we basically look for the pricing and the margin structure of those products to be comparable with with the Sovos average, so that they're equal to margin or potentially margin accretive when we launch them versus margin dilutive. And we are very, very excited for that frozen pizza launch. I've been public around, we tested that business. We were in 4 retailers for about 7 months, fine tuning it until we launch nationally. And that'll be rolling out all throughout this year. And we've got really high expectations for that pizza launch, which is the 5th category now that we've entered into post our acquisition of the Sovos sauce brand in 2017.
That's a lot of taste testing. I'd like to get in on the 5th or 6th month of that taste testing. Todd, thanks so much for taking the time here with us. We got to check back in on you, and we'll continue to keep an eye on the stock movement here. Todd Lachman, who is the founder and CEO of Sovos Brands. Appreciate it.
Thanks so much. Great to be with you.
Likewise. And let's do a quick check of the markets here, sponsored by Flex Shares. All major averages here in the U.S. are lower fractionally. The Dow Jones Industrial Average down the most on a point and percentage basis here today, down 285 points, which equates to about 0.9%. We'll round that off to S&P 500 down 0.4%, and the Nasdaq Composite down 0.1%.
And what better way to leave, folks, than to tell them what's coming up? Three big things coming up on Yahoo Finance Live. First up, Disney versus DeSantis. Investors were waiting for Bob Iger to get fired up about the Florida governor on the call. They weren't disappointed. Iger used one word to sum it all up: retaliation. Rochelle Akufo is going to dig into the drama in just a bit.
That's right. Plus, we can all buy ourselves flowers, but apparently people are choosing not to. 1-800-Flowers reporting slower sales from Valentine's Day in the latest quarter. Rochelle Akufo speaks to the CEO in the next hour.
Now that song's going to be in my head. And finally, who doesn't love a hot glazed donut? A lot of people, according to Krispy Kreme's latest earnings report. Ooh, the CEO is going to join our 3 to 5 team to dive deeper into those numbers. As we mentioned, Rochelle's got you for the next hour of trading. We'll be back tomorrow.
The hot light's always on here, though, folks.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching this morning. Searching for the Goldilocks economy. Bets rising the Fed will hold steady next month amid signs of slowing inflation. But is a June rate hike really off base? We speak with a leading voice on that. And no magic for Disney shares this morning. The entertainment giant loses another 4 million Disney Plus subscribers. We'll deep dive into another ongoing battle for the company and its legacy business. And not folding yet. Google's foray into the foldable smartphone market leaves one notable exception, Apple. So why hasn't it jumped on the bandwagon? We ask one expert coming up this hour. But first, let's check in on the major indices here. Have really been searching for some direction, especially since regional bank stocks under pressure again, with PacWest saying deposits declined last week and pledging an additional $5.1 billion in assets to the Fed to shore up its borrowing. But we are seeing the Dow now selling off about 260 points, though, off the session lows of the day. The S&P also down about 1/3%. They're dragged down by energy. The tech-heavy Nasdaq there just barely in the red, though, by about 6 points. Let's also check in on that Treasury market, as we did see the VIX rising and something of a flight to safety here. We see the 5-year down almost 2% on the day, the 10-year down 2%, and the 30-year down 1.5%. Well, the streamers are having a tough year. The name of the game is profitability, but it's becoming harder and harder to achieve it. Media and entertainment companies are raising prices left and right and focusing on ways to cut costs, all while trying to pull a Jedi mind trick. You feel no subscriber fatigue. Well, Disney shares tumbling today on second quarter earnings. As you can see here, the Magic Kingdom has lost about 20 million Disney Plus subscribers since this time last year, and it's planning on raising the price of its ad-free tier. Meanwhile, Paramount is reportedly cutting 25% of its staff in domestic cable networks and shuttering MTV News after 36 years on the air. This according to Bloomberg. Now, Paramount did not respond to Yahoo Finance's request for comment. That announcement coming on the heels of disappointing earnings last week, the company cutting its dividend. Paramount down over 40% since last year. Well, taking a look at Disney shares, though, and how they're trading after second quarter earnings revealed a subscriber exodus. You see they're down about 8% on the day. One thing we're watching on the earnings call was any commentary on the Ron DeSantis Reedy Creek battle, and we weren't disappointed. Disney CEO Bob Iger facing questions about the company's clash with the Florida governor. This is what he had to say.
This is about one thing and one thing only, and that's retaliating against us for taking a position about pending legislation. Our primary goal has always been to be able to continue to do exactly what we've been doing there, which is investing in Florida. Does the state want us to invest more, employ more people, and pay more taxes, or not?
Well, for more on this, we turn to Seth Berenswag. Berenswag, Leonard Managing Partner, good to have you on the show here. So we've had a number of updates here. We have Disney filing a new complaint and also amending their complaint that was based on free speech last week, and really talking about some of the agreements that were with the previous oversight board here. So first, I want to start with this complaint about the oversight board's control over Disney's design and construction at Disney World.
Sure. So basically, Disney has DeSantis caught in a mousetrap. They really have him cornered because Disney has a very strong constitutional argument. The case has been recently expanded to incorporate the fact that the administration under Ron DeSantis has formally not only taken over the Reedy Creek Board, reconstituted it, renamed it, but it also went in with legislative approval a couple of days ago and blew up their construction contracts. And that is allegedly a violation of the company's First Amendment rights. And the core of this case is very simple and very elemental. American businesses, corporations, just like individuals, have a right of free speech, which under the First Amendment, of course, includes the right to free political speech. Disney spoke out against the so-called Don't Say Gay law, and regardless of people's agreement or disagreement with that opinion, the law does provide that the government cannot punish a business for expressing political views. Disney has filed a very strong case, as recently amended, to go after the DeSantis administration for this pure reprisal and political attack. The administration under DeSantis has filed basically a counterclaim, but it is a lawsuit in state court across town, asserting basically the obverse of the same argument, saying that they somehow, Disney, acted unlawfully. But this is a really big headache. I doubt that Iger, with all the headaches he has right now, would have stepped into this morass if he didn't hear from his attorneys that his case is very strong.
And I mean, essentially, DeSantis and the oversight board is saying this is about leveling the playing field here. But Iger also addressed that Disney specifically being called out on its special districting laws. I want you to take a listen to this and we'll get your reaction.
We're not the only company operating a special district. I mentioned 2000. The Daytona Speedway has one. So do the Villages, which is a prominent retirement community, and there are countless others. So the goal here is leveling the playing. If the goal is leveling the playing field, then a uniform application of the law of or government oversight of special districts needs to occur or be applied to all special districts.
I mean, how is DeSantis going to respond to that if it just does occur to Disney and not for some of these other entities as well?
Well, you know, the thing that's really interesting, and I think this is consistent with Bob Iger's comments during the call yesterday, was that there was really nothing wrong with the Reedy Creek district for about a half a century. This has been going on since the mid-'60s. All of a sudden, after they exercise the right of political speech, suddenly it's a problem. The point was also correctly noted a moment ago that this is not a unique district. There are several unique districts within the state of Florida. So the reason why this has come up is not because of some magical concern that the Reedy Creek district is unique. It is not. And I think that the Florida administration under DeSantis has really put its foot in its mouth because the counter case in the state court is very weak. I've read it. It's probably going to either get stayed or consolidated over to the federal court. This is Ron DeSantis taking a sledgehammer and beating up one of the biggest corporate engines in the state of Florida. They employ tens of thousands of employees. They bring in tens of millions of visitors. And this is going to end up being a legal and political embarrassment. This is a case that will be moving rather quickly over the next couple of weeks.
So then would you say that DeSantis and the board really have any chance against Disney at this point?
I really don't think that DeSantis and his newly reconstituted board, which are really just his political appointees, have any likely chance of success in this case. The Disney lawsuit has been very carefully framed out. And keep in mind that usually, sometimes in cases, it's difficult to be able to get into the mind of your opponent to be able to prove that this was done with retaliatory intent. Well, here, that's basically a cakewalk. You have all kinds of statements by DeSantis, by his board members, by the state legislature that have made it very clear that this is pure political reprisal. So this is a very strong case, and this will really end up being an albatross around DeSantis's neck as he contemplates running for president.
And what sort of precedent do you think this is going to set when you do have a company as impactful on jobs and taxes as Disney does in Florida?
Well, I think it's going to set a critical precedent. This is unusual. This is not the only time in corporate litigation that a company has tried to flex its muscles against political reprisal, but this is clearly the highest level, highest profile case where a corporation has come under attack allegedly by a government for political reprisal for the exercise of their First Amendment rights. So if Disney wins this case, which I predict it will, this is going to mark a major precedent in corporate America from a constitutional framework, but also in terms of best governance and practice. The government should not be in the business of sledgehammering its blue chip corporate employers in the state. And if this turns out the way that we believe that it does, this is going to set a precedent which will be not only very good for Disney, but will also be quite positive for corporate America as they continue to try to operate their business without outside government interference.
And certainly, especially as we see more companies sort of weighing into some of these political discussions as well. A big thank you for joining me this morning. Seth Berenswag, thank you for your time.
You bet.
All right, taking a look now at shares of Krispy Kreme trading after posting strong first quarter results today. We see the stock in the green about 1% so far. Revenue coming in at $419 million. That's 17 million higher than estimates. There's also growth of 12.5% since last year. Adjusted earnings per share beat by 3 cents. The donut maker's e-commerce revenue grew 23% on an annual basis. And big wins on organic revenue growth, up 14% in the US and up 7% in the international segment. Krispy Kreme CEO Michael Tattersfield stressing the growth of donut sales across retail giants like Walmart and Target on that earnings call. I know I've done my part to eat quite a few of those. All right, stay tuned. Yahoo Finance will interview Tattersfield at 3:40 p.m. Eastern. You don't want to miss it. All right, coming up, bets are rising that the Fed will hold steady next month amid signs of slowing inflation, but our expectations for a June rate hike really off base. We'll discuss next. Let's do a quick check of the market sponsored by Flex Shares. We're still seeing some selling action going on here off the session lows, but markets still searching for some direction, waiting to see what the Fed will do as we're getting some signs of inflation moderating. The Dow, though, offered more than 270 points there, down 0.8%. The S&P 500 also down about 15 points. The Nasdaq down ever so slightly, about 7 points so far this morning. Well, the word heard around the world, inflation. The latest data around the globe is showing some signs inflation might be slowing, but it's not exactly a clear picture. Now let's let the data speak for itself, and we can start right here at home. The Consumer Price Index, a key inflation gauge, rose 4.9% from a year ago, just a touch lower than March's 5% figure. And the Producer Price Index, which the Fed prefers, rose 2.3% on an annual basis. Now that's below estimates and the slowest annual increase since January of 2021. Meanwhile, in China, consumer prices rose 0.1%. That's the slowest pace in 2 years. Taking a look at the Eurozone, inflation there has dipped from a double-digit peak for the first time in 10 months, allowing the European Central Bank last week to slow the pace of its unprecedented rate of interest rate increases. In the UK, however, inflation remains stubbornly high, sitting above 10%, which caused the Bank of England to hike rates today to the highest level in almost 15 years. But the truth is, we're not even close to where we need to be. Eurozone inflation stands at more than 3 times its target, and UK inflation remains in the double digits. Here at home, we're way above the Federal Reserve's 2% target, so for now, inflation worries will linger. Well, what does the inflation picture mean for the Fed here in the US? The latest report this morning was another sign price rises are starting to slow, if very gradually. April's producer price index rose 2.3% on an annual basis. That's below estimates and the slowest annual increase since January of 2021. Let's break it all down with George Ball, Sanders Morris Harris Chairman. Thank you so much for joining me this morning. So, obviously, trying to make sense of here, searching for some direction. You had the CPI print and today's PPI print, slowing, but perhaps not as fast as the Fed would have liked. How hard, though, will it be, do you think, for the Fed to justify not pausing in June?
Professor Minsky is famous for the Minsky moment, which I think said that if debt levels get to be too high, there's a catastrophic impact on asset prices. He also said one other very interesting thing, which was the past is instructive, but not predictive. And the data sets that the Fed, that everybody is getting are past and instructive, but they aren't necessarily predictive of the future. With that said, there are some things I think that are predictively quite commonsensical. The Fed's not going to cut rates anytime soon. It's not going to happen. It's a dream. I don't care what the punter's odds are. The Fed is not going to cut rates anytime soon. Their job is not finished. If you step back and say, well, you've got inflation running at 2 or 3 times what a norm would be, as you pointed out before, it's still very debilitating to the average man whose wages are diminishing in real terms quite substantially. Thirdly, my prediction, people won't talk about it very much, but it's sort of being said. The Fed's not going to try to get inflation down to the 2% goal. It's going to get to something like 3%. And at that point, it'll consider the job done because the Fed wants to be popular, not unpopular. Getting to 2% is going to cause a recession and a lot of gnashing of teeth. And so 2% is gone. It's 3%. Really, 3% is the new 2%.
So then, realistically, when can we expect to get down to that 3% level, based on what we're still seeing, some of these repercussions from, tighter lending, some of these regional banks still under pressure as well?
The one sentence answer, I think, is by the end of the year. Fed is not going to cut rates between now and the end of the year. What it's done up to now is more than sufficient to gradually drag the various components of cost of inflation, PPI, CPI, down to something like a 3% pace in November, December, January, around then. Banks are slowing their lending very markedly. Their credit standards are much more stringent than before. And that alone, with nothing to do with the Fed and the rates, is going to slow the economy down quite a bit and actually cause either job losses or a halting in job gains over the next few months. Bank lending standards, unrelated to rates, are much more stringent than they were just a few months ago, and that will put a brake on the economy and bring the inflation rate down to something like 3% around the end of the year. But no cuts prior to then.
And it's funny because investors at one point just seem to be jumping ahead, ignoring the Fed, even though they were saying higher for longer, seeing some selling off today. But I mean, when you look at FANG stock performance so far year to date, I mean, they seem to be looking past the Fed. You've got Meta, Nvidia up more than 90% year to date. But when you look at some of the other indexes outside of the FANG effect, what is the real story here? What are markets actually doing?
The FANG type stocks, which were down 50 to 75% in 2022, rebounded 25% plus or minus from this lower base in January. Since then, they've been comparatively dormant. There's a rotating up, down a little bit, not much. But if you go and exclude just 6 stocks, big technology stocks, the markets are broadly up between 1% and 2%, depending on the measure that you want. So the market this year has been flat, except for a bounce, that cat bounce or a rubber ball bounce in the FANG stocks off the very depressed levels. That said, as you point out, the market is quite resilient. And I think that investors believe companies can prosper and maintain their profit margins even in a 5% rate environment. Corporate managements are very skilled. They know what the backdrop is going to be. And the current rates of interest are not going to be calamitous for earnings or for the economy in later 2023 and into 2024, I think.
And you mentioned earnings there. We heard a lot about AI and a lot of these promises about how companies plan on investing, really pouring in here. So obviously it's going to benefit some companies more than others. But as you look ahead at how you're allocating your portfolio based on what you heard on some of these earnings calls, where do you see the best places to really approach the rest of 2023?
Let me answer your question upside down. I think that the biggest tech stocks, the FANG pluses, as broadly defined, are not the right place to invest. They're so big now. They're great companies. They have a whole lot of cash. They're doing well, but they're so big that they can't grow nearly as fast as they used to. They can't, therefore, justify the same multiples of earnings or revenues that they sold at once upon a time. They will improve profit margins. That was anticipated in their stock prices, but they're single-digit growers, not double-digit growers any longer. However, technology is where the world is going to grow. And there's a large set of substantial, profitable, well-capitalized technology companies that I think will be the right place to invest and to overweight investments in the second quarter and then in the second half of this year. They're apt to do quite well because they are growing at 20, 30, 100% a year in revenues, and they are profitable or profit conscious now. So that's a very good place to put money.
I appreciate you joining us this morning. George Ball there. Sanders Morris Harris, Chairman, thank you for joining us. Have a great day. All right, coming up, initial jobless claims come in above expectations at 264,000. That's the highest level since October of 2021. So is the labor market really cooling? We ask Dartmouth's Danny Blanchflower next. US jobless claims out this morning rose to the highest level since 2021, signaling widening cracks in the relentlessly robust labor market. This, as separate data out last week, saw still strong hiring numbers. Joining me now for a closer look at the labor market is David Blanchflower, Dartmouth Professor of Economics. Thank you for joining me this morning. So we're trying to get a really full picture of what's actually happening with the health of the labor market. Talk about some of the things that actually characterize whether or not we are in a healthy labor market.
Great question. Well, the thing that I would say is that people have made a huge mistake by believing that looking at the unemployment rate tells you anything. I've been working on that for 40 years. Turns out since 2008, to say this is an important fact, the unemployment rate no longer tells you about labor market slack in the economy. And the reason it doesn't is it's unrelated to wage growth. And what it does is it underestimates how much labor market slack there is, which explains why wage growth is not higher than it is. So if you look at the unemployment rate, everything looks rosy. But if you look at things like the labor force participation rate or the non-employment rate, that tells you a very different story. Unlike other countries, many of whom have seen declines in the unemployment rate as the US has, the US's non-employment rate is 3 or 4 percentage points below where it was in 2000 and is still below where it was in 2020. Which says to you that there's lots of people out there in the labor market who want work. Contrary to what people say that actually the labor market is tight, these people are out there looking for work to come back from out of the labor force, and their presence is actually what impacts wages, not the unemployment rate. And I wrote a book called The Wage Code, which was all about that. That's not true anymore. So the story in the labor market is that there's much more slack than people think, much more slack than the Fed says that there is. And that explains the period from 2010 to 20, which nobody else can really explain. Why, when the unemployment rate went from 10, 9, 8, 7, 6, 5, 4, 3, did wage growth not rise? And the answer is that that's the wrong measure to look at. I have a whole series of papers on this. You should take that away from your thoughts, and you should focus on non-employment, but also on underemployment too. Those are the variables that we care about. But to say, in a particular way for your listeners, the unemployment rate tells you nothing about the state of the labor market since 2008. It used to, but it doesn't anymore.
And so you mentioned non-employment, underemployment, as well as inactivity then. How should that be shaping, especially Fed policy, given that that's one of the things that they look at the most when determining their monetary policy?
Well, it means the capacity of the economy to grow and create jobs without creating lots of high wages is much greater than the markets and most of your commentators seem to think. So it means the potential to basically expand is greater. It means that the view of the Fed that you've got to raise rates is wrong. And essentially, the markets are with me, because the credibility of the Fed and these commentators that I've just been listening to, who I don't agree with really at all, but the markets are saying this has gone far too far. And I think if you look at it today, they're pricing in 8 rate cuts starting in September through a year from September. So there's much more slack than people think. And what's going to happen is you're going to start to see really bad data. And the mistake from the previous commentator, the mistake was to say that central bankers look at the current inflation rate. That makes no sense whatsoever. And I was a policymaker who set rate. That's the last thing you want to do. What you've got to think about is what's inflation going to look like in a year to 18 months' time. And today, the Bank of England raised rates with a forecast that says in 18 months' time, inflation is going to be way below the target at 1, which means that it should have actually been cutting rates. So most of the commentary doesn't understand the nature of the labor market, doesn't understand how monetary policy is set. You never set, if you say to me, how should I respond to today's inflation rate? The answer is not at all, unless it surprised me. Did I think this was going to happen a month ago? Yes. So if it does this month, do I respond to it? No. So I care about what's happening going forward. And it looks to me that bad data is going to come, and the market's completely right to build in lots of rate cuts. And in fact, you may see, if the data gets really bad, you may see them pricing in even more rate cuts, forcing the Fed to respond. But the reality is, because the market thinks rates cuts are coming. That is stimulus. So if the Fed does the cuts the markets have priced in, that doesn't do much. If they don't do it, then you'll see a market reaction.
As you mentioned, because they've already factored that in there. So then when you look at deflation, you said last year in your op-ed to Politico that deflation, not inflation, is the real concern. After a year's worth of rate hikes, do you still feel the same?
Well, there's a couple of things to say. I mean, again, the conversation sort of forgets this. If you go to 2008 August, where many of the conversations were like this, all missed the Great Recession coming. And the big worry then was about rising oil prices and high inflation. It was in the fives. Well, now 5.2 or so in August 2008. Well, I wonder what listeners think it was in August 2009, minus 2.1. So it's not as if history can't repeat itself. And what happens as these base effects start to drop is that the one this month wasn't that big. The next two are going to be pretty big. In the UK, they're going to drop a 2.5 next month. So the reality is that deflation, and the Bank of England today is actually forecasting deflation with a probability of about 25 or so. And if you look back, we have data for 800 years of data. And what you see generally in response to inflations of around 10 or so, in the last 800 years where these things happen, half the time there was a giant response to deflation. Perhaps not long lasting, but that really is the risk. I mean, people are sort of saying it's not this, but this was exactly what happened in 2008. So I think the reality is that below target inflation is potentially what's coming, especially if we see drops in oil prices. And we continue to see things like drops in lumber prices, which are back to pre-pandemic levels, drops in the cost of shipping, that's back to pre-pandemic levels after giant increases. So if you have that, I mean, the way I always think of it to people is prices go from 100 to 110 in the first year. That's 10% inflation. They go to 110 in the next year. That's zero inflation. And they go to 105 in the following year. That's deflation. Even though prices are 5% higher than they were in the first period, if you go from 110 to 105, that's deflation, and prices are still higher. So I think people have underpriced that, and the danger is that we will undershoot the target, and that forces the Fed to move. But the market's thinking that. The market thinks that's what they're going to see, which is why they've priced in 8 cuts, which I think is completely appropriate.
And I do want to ask you about sort of where the future of jobs are heading. We heard a lot about AI and whether it's contributing to sort of efficiencies as well. I just want to quickly play this clip for you from Robinhood's CEO. He spoke to our Brian Sozzi about AI's future on yesterday's earnings call.
I think that over the next few decades, every company will have to transform into an AI company. The companies that have been able to move ahead and create differentiated value have been technology companies, in the same way that every company sort of has needed to become a technology company. I think AI will sort of be embedded into the fabric of all companies.
Well, first, I want to know if you think that that is going to be the case, that it will be part of the fabric of all companies. And what does that mean then for the workforce if you do have this shift to greater AI?
I think he's probably right. The problem is that people have assumed, and if we go back to the Luddites thought that technology was going to be job destroying. But if you look back over, let's say, the last 25 years, actually lots of new jobs have been created around technology. You know, when you have your dishwasher repaired, the plumber doesn't come, the computer guy comes to deal with the computer that's in every one of your machines. I mean, yesterday my coffee maker is blocked, and I got a message on my phone saying there's a problem with your coffee maker. I think that's the first thing. I think this is job generating. It's just job different. And I think, in a sense, your question is something I've thought about endlessly. But if you think, let's say I was to go back each 10-year period, and you say to me, so what do you think's coming? What are the new jobs over the next decade going to look like? And the answer is I would have had it wrong. It would have been very hard to work out that be an Apple store, and I'd be talking to Yahoo Finance on my Zoom. So I think the answer is it's hard to know, but I think there's big changes coming. Obviously, we're seeing this technology impacting things. Zoom's a big deal, and we're seeing evidence that the inner city is in decline. So if you look at things like, you know, beeps of phones in downtown. In San Francisco, it's about 25% of what it was. In Boston, it's 50% the character of working has changed, but jobs have changed, and we're seeing rapid change around this technology. In many senses, it may well be job enhancing, not just job destroying.
I think that is a good way to look at it. And as you mentioned, I mean, 3 years ago, no one was thinking about, Chat GPT and everything else changing things. A big thank you. It's been great having you on. David Blanchflower, Dartmouth Professor of Economics. Thank you so much.
Thank you.
All right, coming up, not folding yet. Google's foray into the foldable smartphone market leaves one notable exception, Apple. So why hasn't it jumped on the bandwagon? We ask one expert next. The AI battle escalates, with Google launching an AI-powered search tool as it goes head-to-head with Microsoft. Yahoo Finance's Dan Howley joins us now with the latest. Hey, Dan.
That's right, Rochelle. I'm here at Google's campus, Google I/O, just yesterday. And really some of the big announcements that we saw were all about AI. I mean, this company came out swinging. They really kind of lost the public conversation in recent months, going back to February when Microsoft unveiled its generative AI-powered Bing chatbot and search engine. And so Google's been kind of searching to catch up with that on its own. And it did just that yesterday. It announced a slew of new features for its search engine, including generative AI capabilities. And it announced that its chatbot, Bard, is going to be available publicly. And so people will be able to jump on that. Now, the search part of things will work like this. You'll be able to do your standard search, but use a basic conversation structure. Type in a sentence. One of the examples they gave was, why do whales sing? And so from there, you'll see, using this experimental AI version, a list of reasons why whales might sing: communication, looking for prey, things along those lines. Below that, you'll see images of whales, and then they'll perhaps give you an idea of where you can go see whales do whale watching tours. So part of this is giving you the generative AI aspect, but also a signal to advertisers that, hey, we're not leaving this behind. This is still our bread and butter of our business. We're just including it in a different way. Outside of that, they also discussed some of the ways they're bringing generative AI to their workspace. Now, that's basically their Microsoft Office equivalent, or Microsoft 365 is what they call that now. But I digress. It's their productivity suite. And so they're adding new kind of capabilities where you'll have a thing called Help Me Write in Gmail. You also have that in Google Docs, and it'll, basically help you write whatever you're trying to write, whether that's a cover letter, whether that's an email response. And Microsoft, meanwhile, has introduced similar features on its own. So we're seeing this kind of tit for tat back and forth between the two companies to see who is going to be the big AI leader. And Google has decades of experience here. Microsoft partnering with OpenAI. It's not as though Microsoft's AI is too shabby on its own either, but this is going to be a continuing conversation. For now, Google seeming like it's getting back on equal footing after falling behind.
Indeed, it's a catch-up game they're playing now. But as you mentioned there, Google has that vast experience. A big thank you there to our very own Dan Howley. Thanks so much. Google unveiled the Pixel Fold at its I/O conference yesterday, marking its first foray into the foldable smartphone market. The move into the space leaves one notable exception among all these big players: Apple. So why hasn't it jumped on the bandwagon? Joining us now to discuss is Ryan Reith, Program Vice President for IDC's Mobile Device Tracker Suite. Good to have you on the show, Ryan. So first want to really get some background here, starting with Google's phone here. So this Pixel Fold, $1,799 here. Tell me, why do we need this? Why is Google even entering this space right now?
Yeah, well, thanks for having me on as always. Good to talk to you again. I think the short answer is I think it's a little bit of follow the leader in the hardware space. If you think about smartphones, tablets, even PCs to some extent, the hardware designs have gotten somewhat boring. Things have gotten bigger, the glass is there, things are thinner. We've passed all those stages, and the rest of the industry, putting Apple aside, certainly the rest of the phone industry in the Android space has already gone into this foldable form factor. So it's sort of follow the leader. And, anyways, that's really what it is. We're not seeing the demand for these products just yet. I'm not completely pessimistic on the category in the long run, but I think it certainly has its short-term challenges.
And that's the thing, I was asking around as to who actually has a foldable phone. I think only one person that I've spoken to actually has one. So what is actually going to be driving the demand? And people already pay so much for the phones they have. What is going to make them want to switch to these sorts of devices?
Yeah, I think it's a good question. Certainly not price, right? I mean, even at $1,800, let's just backtrack, right? I mean, when Samsung launched the first, I think, foldable back in 2019, it was $2,700 if I'm not mistaken. So it's come down, and there's foldable phones. I was in China a few weeks ago, looking at some phones from some of those OEMs in Android space that are of the flip form factor, but still, and they're $600-700 cheaper than this. So what's driving Google around this? I don't quite know, other than maybe the ability to get their software developers that follow Android to develop for this variation of a foldable ecosystem, which it does need variations of the application. So there is something there. To answer your question, the consumer, what's going to drive them to buy this? I don't see anything until the use case really shows up. And I think right now what we've seen, the buyers globally on this have been what we would consider early adopters, not what's going to drive the needle. So it's really going to need a proven use case. And like I said, maybe Google is using this hardware as a way to get their developers to develop on that, and then ultimately could, help other Android OEMs. But it's kind of it's always a chicken and egg with them, because you never quite understand which side is really about driving the Android ecosystem versus the Google hardware ecosystem.
And, Apple not jumping into this foray just yet. Samsung sort of off to the races for now. But why do you think Apple hasn't stepped into this space yet?
Honestly, I think it's they understand the market right now, and they understand that the demand isn't there. And this is not new. I mean, I was listening to your previous segment on AI, which was very interesting. And I think, Apple's also not one that has spoken up about generative AI. They have not, made a public statement about a foldable phone. They've also, by media sort of headlines, continued to delay their sort of AR or VR headset. And to me, I think hopefully the industry knows this. They have had and they've been testing the capabilities on everything, including foldable phones, for a while. I think that they wait till the pulse on the industry and from a demand standpoint is right. And I don't think it's right now.
And so then just quickly, market leaders in this space.
Yeah. Samsung owns 80% of this market. I think to be precise, last year, I think our data was 82% of the global foldable phone. And just to be clear, for those that look at the specifics, that folds this way and also flips. Any type of smartphone where the screen bends, they own 80% of that market. Let's just call it that. And from a volume standpoint, the market almost doubled last year alone. Went from 8 million units in 21 to about 14 million last year. And we assume it's going to be somewhere around 21, 22 million units this year. So yeah, from a growth standpoint, it's growing. It's coming from a zero base. And keep in mind, we're talking about a market size that's 1.2 billion. So we're talking about a percentage point. We're also talking about a time where the economy is not good. People are not willing to spend more, and it's not proven use case. So again, it's a really tough ask right now to get people to spend more on something that they don't quite know yet that they need it. Again, I'm not completely pessimistic in the long term. I think that use cases can be proven around foldable displays. I don't think that they're there yet.
Yeah, plus I'll have to see how much it costs if I drop it as well. Something that we're all going to do as well. A big thank you there to Ryan Reith, Program Vice President for IDC's Mobile Device Tracker Suite. Thanks so much. All right, coming up, from foldable phones to flowers, how 1-800-Flowers is holding up ahead of Mother's Day. We'll speak with the company's CEO next. 1-800-Flowers is getting a boost today despite slowing gifting sales taking a bite out of the company's revenue, which fell over 11% year over year. Chris McCann, 1-800-Flowers.com CEO, joins us now. Good to have you on the show here, Chris. So talk us through some of this earnings data here and what you think the markets are making of it.
I think the markets are looking good. First off, happy Mother's Day to everyone in the audience who's celebrating this weekend. It's a special day for sure. I think what the markets are reacting to is how our management team is really responding to what we see in the macroeconomic environment. The consumer is cautious, but what we've been able to do with soft revenue on the top line, we've been able to increase our gross margin and increase our EBITDA during the same time period. So the investment community sees that we're managing very well through this economic challenging times that we're dealing with.
And it's interesting because a lot of discussions that we've had with providers has been, are we seeing customers trading down? But you're actually continuing to see customers trading upwards. What are some of the things that they're trading upwards on, and what sort of spend are you seeing?
So we see a couple of things there, Rochelle. We see consumers in our product category will spend more money. They'll want to buy, especially a food gift during the recession. They might move off a floral into a food gift, which carries a higher average order value. We're seeing our higher end customers from a household demographic point of view, who maybe aren't as affected as some others are, still spending more money, and we're getting price increases up around the $100 price point. But the key for our company and the key for the platform that we've developed with all of these brands and all of these product categories is to give choice and to make sure we're giving choice of price point and choice of product for every budget and every occasion.
And I do want to ask you about the distinction between corporate gifts and some of these personal gifts as well, because you have that acquisition of Smart Gift as well. You'd already been working with the company on some things with Universal in terms of gifting movies and things like that. Talk about the benefits of this acquisition and how that really adds to the portfolio here.
Yes, we've been working with the founders of this company who are just great people, a husband and wife team, and they've just developed this knack for gifting. And so there was a natural affinity between our two companies. And we really see the opportunity to take this smart gift platform that we've been developing with the team into our corporate customers to really help give them a good ability to manage their client gifting, manage their employee gifting, be able to measure a return on that gift. So it's bringing capabilities to our corporate clients that really help them look at it from a science point of view and not simply a goodwill gesture.
And even though, of course, the company 1-800-Flowers, a number of brands come under that umbrella. Talk about some of the moves that you're making there and really the sort of build that you're seeing there and some of the more successful parts of the business.
Yes, M&A activity is part of our strategy going forward. So it's organic development, organic growth coupled with M&A activity. And we look for two things when we're looking at an acquisition. Can they leverage the platform that we've built, the consumer-facing platform, the operating platform, or do they add to the platform? So two examples. A couple of years ago, we acquired Personalization Mall. There we added significantly to our platform the whole personalized capability and moved into a new product category for us. Also, a couple of years ago, we acquired a brand called Shari's Berries from a bankrupt competitor of ours. We took none of the assets. All we did was take the intellectual property and put it completely on our platform, leveraging the platform to take a business that was losing money and not growing to turn it around into a profitable growth business for us. So we look at those capabilities. Smart Gift is an example of that, just a technology capability we acquired. Things Remembered is an acquisition that we did that leverages the personalization capabilities that we have. So we look to make sure that we have multiple ways of growth.
Now, something that's interesting, you mentioned technology. You have this AI chatbot, this Momverse bot. Tell us about that, because some people are on the fence as to whether or not they want AI writing their Mother's Day poems for them. Talk about why you decided to go that route and where else we might see 1-800-Flowers incorporating AI into the business.
Well, I can guarantee you there's plenty of customers out there that are looking for ChatGPT to write their Mother's Day card. I can guarantee you that. But we're a company that's been a culture of innovation that has begotten us a culture of reinvention. And by embracing new technologies, we continue to transform our company from a brick and mortar retail business to a telephonic commerce business to an e-commerce business to a mobile commerce to now a conversational commerce company. And embracing new technologies like AI and giving the customer a chance to play with it. We're all in the learning stage of what ChatGPT and what this generative AI capability can bring. So let's give our team something to play with and have fun with, and the consumer as well. So generating a lot of these messages, we're seeing customers have lots of fun with this. Quite frankly, we're all having lots of fun with it internally in the company as well. It's just a great product and a good way to see how everything that we're hearing about in the news, artificial intelligence this, artificial intelligence that, this gives us a good applicable way to demonstrate the capabilities.
But I love that. And what a fine occasion to use it on. A big thank you there. Chris McCann, 1-800-Flowers.com CEO, and a happy Mother's Day to everyone at the company too.
Thank you, Michelle.
All right, taking a look at shares of Peloton, trading down on a recall announcement, off about 7% so far. The U.S. Consumer Product Safety Commission announcing a recall of 2 million plus exercise bikes. The release says the bike's seat post-assembly can break during use, posing fall and injury hazards. The commission has received 35 reports of the seat breaking and 13 reports of injuries, including a fractured wrist, lacerations and bruises. And this is not Peloton's first recall. In May of 2021, there were recalls of Peloton's Tread Plus and treadmills. One child died after being pulled under the machine while it was in use. And additionally, the company received 72 reports of adults, kids, pets, and objects being pulled under the rear of the machine. That's certainly a stain on the company's name. Months after that, Peloton experienced a PR nightmare after HBO's Sex and the City reboot went with a storyline that involved the character Mr. Big having a heart attack and dying after riding a Peloton bike. That sent shares tumbling back in December of 2021. Now, the stock has seen significant turbulence over the years. As we take a look here, shares down more than 43% over the past year. Now, you can see the stock spiking during the pandemic when everyone, including myself, wanted at-home exercise equipment, peaking in 2021 before starting its descent. As you see there, over 5 years, down 72.8%. Well, that'll do it for now. I'm Rochelle Akufa. I'll be back with you at 11 a.m. Eastern tomorrow. Take care.